everybody's improved on sentiment, but the data is not telling the same thing.
The economy has really shown that it has been relatively insensitive to higher interest rates so far.
Strong wage growth is causing inflation, but it's a barrier to lower inflation.
I wouldn't be surprised to see the Fed go another 25 or 50 basis points.
I think by the end of this year, the economy starts to go into a mild recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Breaking news, TK. Last 30 minutes or so, you haven't read this yet, but it's in from The Athletic. They're reporting Bayern Munich have reached an agreement with Tottenham to sign Harry Kane. Can we shift the camera to TK just really quickly?
This is a big deal. And, you said, how does a franchise pick it up, John? But, this is a seismic deal for English football. Explain to our audience in America, like me, that really doesn't understand the Kane magic.
Accepted a €100 million offer. Let's see if Harry Kane goes forward with this and what kind of contract he agrees to with Bayern Munich. He wants to win, TK, wants to win trophies, and it looks like he's going to Bayern Munich to do it, according to The Athletic's reporting, and we're waiting for an official response from the football club. Tom, I think he's something like 51 goals behind Alan Shearer, who was a phenomenal goal scorer in the Premier League, to become the top scoring striker of Premier League history.
Right.
And he's going to leave potentially, Tom, before he reaches that milestone.
We've got a lot to talk about this morning, but just one quick question, John. Explain Bayern Munich as compared to AC Milan, as compared to Paris Saint-Germain, as compared to the Tots.
Elite. And Tottenham is not in that group at all.
I'm asking.
Tottenham does not challenge for those titles. TK came close once, hasn't come close again.
Right.
And for that reason, he wants to go and win at the highest level.
Adele, I'll call you back. Bye.
Are we done?
Yeah, Adele's...
I wanted to break that news for you, Tom.
Well,
I know you might feel a little bit emotional
for
about
Adele and all that
Harry making a move.
I was surprised it wasn't a big reaction, frankly.
I thought it would be too.
It was obvious. He was like, oh, yeah.
Bramo
that's
knew.
Right.
I told Lisa before we came to air.
No, actually, you just said, I'm going to break something. I knew exactly what it was before you even said it. I was like, oh, Harry Kane must have left.
If you were hoping that I had CPI under embargo or something. No, nothing like that. Let's start the show again. 3, 2, 1. From New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. It is CPI Wednesday? CPI Thursday. Thank you. Equity futures on the S&P 500. Positive by 0.5%. TK, the data, 2 hours and 30 minutes away.
The data's there, and the sum of the data and the importance of the data to get to Jackson Hole and to get to the Fed meeting and all the other economic data. I guess you got to look at core inflation because top-line inflation's going to be affected. They've got the pop in gas prices. We saw the New York City rent story out on Bloomberg today. You know what? It's about core inflation.
Core inflation, then on to the Federal Reserve meeting on September 20th, Bramo. Are we going to see further signs of disinflation to open the door to that pause they seem to be embracing at the moment on the committee?
The weirdest part about this CPI report is everyone expects it to confirm that it's going to be a soft landing, confirm disinflation, confirm all of the trends that would lead to the same bets that you're seeing in the market, which is the Fed is done and they're going to start cutting rates possibly by early next year. The problem is the disagreement comes on what's next and how much do you dismiss this as a head fake? And that is what we're going to hear from person after person that's going to say the year-over-year comps get a lot more difficult later in the year.
What's the biggest risk here, Tom? Backing away too soon or staying with it for too long?
For the central bankers of the world, the number one risk is backing away too soon. That is their collective memory of 30 years. And the right word here is it haunts them. At Jackson Hole, international audience, it haunts them.
The 70s haunts them. You got that sense from Chairman Powell maybe 12 months ago. Do you get that sense now?
Yeah, I think they're really, really concerned about making, the joke is a folk's paw and all that. Well, you know what? You're going to make a folk's paw and go up and it's oops. And that's where you listen to Hollenhorst at Citigroup and you go, yeah, well, okay. But at some point you got to turn.
I have to respectfully disagree. I feel like the sort of tide has shifted and suddenly the Fed now feels they're more worried about disrupting a labor market and the possibility of a soft landing. That's sort of the holy grail out there that they're going to achieve this time. And oh my goodness, we're going to go down in history as the ones that finally did this. And they're more concerned about that than the haunting of the 70s.
Yeah, and this is important. I did a fancy math study this morning, log regression, core inflation.
I didn't.
To get back to 2.0% on the vector right now, it's so gentle, spring of 2026. That's how far away their babble is.
This is the best start to the programme we've ever had. Your equity market on the S&P looks like this. Equity futures positive by 0.5%. Going into that economic data, yields unchanged, just in and around 4% at the close every single day so far this week, Lisa. That's where we stay. We're going nowhere. 4.01% on a 10-year this morning.
Yeah, although the euro actually went to 110. It broke out of the 109 range. So look at that. Honestly, today the big move is going to be 8:30 a.m. US CPI. And the expectation is for a 0.2% month-over-month gain for both headline and for core. Very curious to see what counts as a soft landing type of print and where the bias is in markets. Right now, it feels like people really do believe the Fed is done. They want to hold. They want excuses to start moving away from the restrictive policies. 1 p.m., this is really the key moment. The U.S. is selling $23 billion of 30-year bonds. This comes after an auction of 10-year notes yesterday. That was fine. It wasn't awesome. It was fine. You still those yields just about 20 basis points away from the highest levels going back more than a decade. And today, Fed speakers line up. Same ones, actually. Atlanta Fed President Raphael Bostic. We've been hearing a lot from him. And Philadelphia Fed President Patrick Harker. A lot from him, too. 3 p.m. and 4:15 p.m., respectively.
Can't wait. Coming after the economic data a little bit later this morning. Margie Patel joins us now, Senior Portfolio Manager at Allspring Global Investments. Margie, let's talk about the data first, what you and the team are looking for a little bit later this morning.
Well, we think that we'll see inflation numbers possibly coming down a little, but I don't think we're going to get any relief and a big break in inflation down that will say, oh, okay, the Fed's done and we'll have clarity there. We think it's more the same, inflation being a little disappointing.
Let's cut right to the chase, Margie, on yield right now. Is dividend and dividend growth a yield equivalent or a constructive use of yield, or do you have to go to higher yielding fixed income right now?
Well, I think that if you can find companies that have good growth and a reasonable dividend, that's a good strategy rather than just going for big dividend payers, because that hasn't been a very successful strategy. In the fixed income market, high yield looks like the best place to be, as it's been ever since the Fed began tightening last year. You can get, say, 7 to 8.5%. Most bonds are a little discount. So for a fixed income investor, That's not bad.
I'm fascinated, Margie, by what CFOs do. If you finally have higher yields, if you finally have a legitimate real yield, do they lessen issuance or not?
You know, they've been so opportunistic about raising money, lengthening out their debt obligations over the last decade that I think they're still going to see more of the same. We've had a drop in the amount of issuance from corporations, investment grade and high yield. I think reflecting the fact that they really don't need the money at all, and the fact that rates have pushed up from where they were, say, a year or two ago. So I think they're going to continue to do that. The good news is corporations really don't seem to be stressed in general. They really don't need the money in order to operate. So that's pretty good for the economy.
And there's a feeling, a bias perhaps in markets, that the Fed is going to move away from their restrictive policies well in advance of some of the maturity walls of some of these companies. So we'll ease the burden eventually. How much is that your base case, and how much will today's CPI report underscore that?
I don't think that maturity wall is really going to be an issue because of the amount of liquidity the companies have. They've spaced out their maturities. A lot of companies have tremendous liquid assets on their balance sheets, so they can meet a lot of those needs internally. And we've seen that maturity wall story come up over the years, and companies have always gotten through it. So I don't think it's going to be an issue this time either.
How much, though, does that idea hinge on this idea of a soft landing, of the Fed cutting rates as soon as early next year, even if we don't see the unemployment rate materially pick up?
You know, I think that's the problem, is when you look at the history books, you look at previous cycles, and you try to think about what's going to happen. And I think that's why people keep coming up with the wrong answer. They don't look at the changes that we've had, a decade of near zero rates, companies, consumers in good shape. And really, it's very hard to see a recession with unemployment at, say, 3.75% no change looking there. Companies don't need to borrow money. The banks have been restrictive for a number of times. So it's hard to see where this recession is going to come from, not from the real economy. And the economy has been pretty impervious to the Fed's increase in rates.
Margie, can we talk about pricing power? I'll pick out a single name, the Walt Disney Company. They came out with earnings after the close yesterday. Subscriptions came in light, yet they're still putting prices up. Can you speak to pricing power across America right now? How strong is it?
Well, I think it's going to continue to be pretty strong. I think Disney's a great example, as they felt they had room to raise prices, and I think they'll be successful in retaining those price increases. And that's one of the reasons why we've seen corporate margins really maintain themselves. A lot of people thought this year we'd see margins really get squeezed, but companies have been able to pass on price increases.
In a blended portfolio, Morgan, you're acclaimed for this. I mean, this is what you've been doing for years, to provide balance. Is a 60-40 portfolio balanced now?
No, I think you really should be looking more on the equity side, even though we've had this big run in equities. And the reason being is I don't think you're going to see much total return out of the bond side. I think rates are going to stay in treasuries relatively high compared to inflation, compared to economic growth, simply because of the tremendous supply the government is going to issue. When
you look at big tech, the dominant companies of this era, are their share buybacks a yield equivalent for you?
Well, you could say that, but some of those techs are trading at very high levels. We still like some of them, but there's a risk that if we see companies start to report lower earnings, and it does look like some of those actually are rolling over in terms of price, we could see a big price correction just because they've gotten way ahead of their long-term growth rate.
Marky, wonderful to get your perspective ahead of CPI a little bit later this morning. Marky Patel there of Allspring. Here's the setup going into the inflation data about 2 hours and 20 minutes away. Your equity market is positive by 0.5%. It's CPI a little bit later. And then the fun and games in this market really get going about a minute after that, or rather seconds after that. Plenty of fun and games with this one stock. Novo Nordisk over in Denmark is trading a little bit lower by 1.5%. The good news is basically a beat in a race, raising the outlook off the back of this blockbuster obesity medicine. Lisa, they can't make it quick enough. There's a supply problem, so the stock is a little lower.
They can't get it to the U.S. as quickly as they need it at a time when not only is it showing high results, but you pointed to that study yesterday about reducing heart disease. And you said basically, this is pretty obvious. If you're losing a lot of weight, then you reduce your heart disease potential ramifications. However, what this does is it gives a pathway to demand from health insurance companies that they actually cover it more significantly. So they will cover the higher price, which is the reason why people said, all right, let's go.
First, I got on the scale yesterday, and it was a beat and a raise as well. You got to be kidding me. What are the health risks of this stuff? Do we know?
We're slowly finding out.
Yeah.
I just, how much weight do you lose with this? I take 10 of these pills. How much weight do I lose?
It's an injection, although I think Wegovy might not be, right? I think
not sure.
Ozempic is definitely an injection, and so that's why the injector companies are going gangbusters also, because everybody's really excited and getting on this train.
How much weight do I lose?
A lot. People lose a lot of weight on these.
Like a pound or two?
You want us to sit here on TV and tell you specifically how much weight you're going to lose based on how much of this you take?
This is a free lunch drug. It's all there is to it. I get it. I hope they work out.
There's never a free lunch.
$1 gazillion. There's no free lunch. If I'm losing weight like that, there's got to be some side effect, kidneys, whatever. I don't know.
What happens to exercise, TK?
I know. Look at me.
Every time we bring up this story. Bramo's done some research, I can tell.
Bramo's done a lot of research.
I think it's fascinating.
Then we talk about it and we crash and burn.
Well, but to me, I find this really interesting because everybody's looking for a new story. AI kind of fizzled yesterday. People were like, maybe we've overblown this and it's not going to necessarily come to fruition. It's maybe a blip. But now everyone's jumping on the weight loss train because if you can promise someone a free lunch, my God, is that going to catch on?
There's a huge obesity epidemic in this country.
Oh, yes.
Massive. Yeah. One thing I was surprised by in the pandemic is that we hardly talked about it. Coming out the other side of the pandemic, hardly talked about it. Yeah. It's kind of amazing, isn't it?
It is truly amazing. True story. Take the cherubs in. They're much younger. Pediatrician, he starts lecturing them on weight. I go, why are you lecturing my kids on weight? They're real thin, skinny. He goes, if I don't lecture all the kids on weight, I'll forget to lecture the ones that need it. It's that bad.
It is terrible. You can see it in the statistics. More than 30% in some regions of the U.S. Account for are morbidly obese. But you're right to point out the pandemic. People staying at home, not exercising. People gained weight.
The amount of deaths that were tied to obesity and the risk factor, the people in that group were at risk of dying from COVID, and yet it just hardly got discussed. And I would have expected after that for there to be some real momentum. To Tom's point, this is a big deal. We'll try and do some work on it for once.
Where is it written that America can't lead the world again in manufacturing? Because we're going to do just that. The leading manufacturer in the world. The plan is to invest in America. We're transforming our country, including by rebuilding America's infrastructure. I'm not here to declare victory on the economy. We have a lot more work to do. We have a plan, and it's turning things around. Bidenomics is just another way of saying, restore the American dream.
President Biden speaking in New Mexico on a bit of a Bidenomics tour across the country. That tour continues today. Live from New York, welcome to the programme. Your equity market on the S&P 500 shaping up as follows. Equity futures positive by 0.5%. Yields unchanged, 4% on a 10-year. The yield below 4% at the auction yesterday on a 10-year maturity. A little bit later, as Lisa indicated, you get a 30-year auction. That coming shortly after the CPI report later on this morning. That report 2 hours and about 13 minutes away. Tom, in the FX market, Lisa made this point, reclaiming 110 on the euro in the last couple of days. Just in and around 109, 110 though for the last 2 weeks. We're positive on that currency pair, 0.4%.
For Global Wall Street, let's do it briefly here, John, because we've got to get to Kim Wallace here. But John, I think euro-yen today is a really, really important day for yen. The triangulation of yen, dollar, euro, and also yen renminbi. We're right at a tipping point with euro yen out to a 158. We're back easily 10, 12 years.
Dollar yen right now, 143.86.
Yeah. The euro yen feels like that's a 145 or a 146. So we'll get to that later. There's a real tension there. This is a joy. There is an award at the Department of Treasury that's really taken seriously among those that provide leadership in Washington. It is the Alexander Hamilton Award, and it is treasured. Kim Wallace owns a high ground and public service at our Treasury. He retired the institutional investor trophy, if you will, for legislative affairs, and we're thrilled he could join us this morning from 22V Research. Kim, just thrilled to have you on into the Republican debate in all. Explain how the culture wars link into your day-to-day grind in Washington. I think for all of our viewers and listeners, it's a battlefield out there. Maybe it's a minefield is a better way to put it. How are the culture wars going to play out as we move towards the primaries and indeed onto the election?
Tom, good morning. It picks up in part of what you all were talking about previously. How much of a free lunch do Americans think they can continue to get from macroeconomic policy, and who sells that to them?
I look at the macroeconomic policy now. Clearly, there are two different visions in Bidenomics and Trumponomics, and the other candidates as well. Fitch got in the way. There was some noise here the other day. Is it really all that fragile out there? Is the late Pete Peterson, Paul Tsongas, and the rest, is that kind of debt concern finally legitimate?
It's legitimate. It's been legitimate for decades. It's just now we don't have any space to pretend it's not there, which means that the macroeconomic challenge in Washington is twofold. First, it's to adjust the country and its citizens to moving from zero bound rates to more restrictive policy and what that will mean throughout the economy that they touch. And then secondly, it's rebalancing the fiscal books. We have a problem in the U.S. The fiscal books have not accommodated this phenomenon of baby boomer retirement. We're adding about 20,000 beneficiaries per month to Medicare. That can't continue unless you're going to raise revenues above the 18% 50-year average, which we seem to be stuck at. So it's one or the other. You either have to trim your outlays, mainly through Medicare, or you have to increase revenues to account for what's never been accounted for in the U.S.
There's a big question about how much this is being accelerated, this concern about the deficit at a time where there are increasing geopolitical fractures, in particular, the U.S. and China moving further and further away from each other. How much is that the concern? The international buyers aren't necessarily the obvious buyers of choice for treasuries in the same kind of way that they always have been.
Lisa, it's a good point. I don't detect that there's a lot of concern about that yet. I do detect that there's a lot of concern that the U.S. is not investing in itself in a way that 10, 20 years from now, treasuries will be as attractive as they are today. That's the big concern, is that from an economic policy standpoint, we're behind, and it's going to take a while to catch up. You see that both in the president's executive order released yesterday on outbound investment, which is really a message to U.S. investors restricting their ability to invest directly, not portfolio investment, direct investment, in quantitative information technology, artificial intelligence technologies, and semiconductors that China wants to continue to leapfrog ahead of the world, including the U.S. And so it's twofold. It's repair your knitting at home, take care of fiscal policy, invest in your people, build in terms of infrastructure, invest in semiconductor and manufacturing base, and at the same time, make sure that investment flows don't strategically benefit a clear competitor.
A lot of people would argue that the argument from President Biden is basically a watered-down missive versus what people were calling for, which was an all-out ban on certain investments or a much more curtailed investment structure toward China and some of their artificial intelligence types of technologies. Isn't that essentially what we're looking at? Something that's not going to go into effect until next year, something that is very narrowly targeted and still subject to change depending on some of the appeals?
Lisa, the complaint is understandable, but it ignores the lift necessary in transformational policy. The president, others, he's not the only, but the president has recognized, going back to the 6 month in office when his National Security Council and National Economic Council issued a report on supply chains, the core of that report was the U.S. is behind in investing in self, and it's behind in paying attention to China and other competitors who have locked out green technology and other technologies that are necessary for the future. And so, yes, when you're the reserve currency of the world, you have to step lightly. But in this case, the president has chosen to step firmly in terms of strategy. It's going to be a bumpy path. They don't want to disrupt the world economy, and they certainly don't want to chase investment away. But it's a necessary move in their eyes.
Kim, you're one of the rare beasts. I think of John Taylor at Stanford as well, with some real international cred in terms of inside the Beltway policy making. I guess we're having a manufacturing renaissance. And percolating in the summer of 2003 is, do we have the labor to fill the factories? How do you respond to the stereotype that we don't have manufacturing in Ohio that can compete with manufacturing 40 miles outside Hong Kong?
Tom, I think the short answer is if we had been doing some of these policies 20 years ago, this wouldn't be a debate. You have to start at some point. And so the president and others, he's not alone. There are others in both parties on Capitol Hill interested in this, but the president is leading. They want to invest in hardware and they want to invest in mindware. And you have to start at some point. You're not going to catch up overnight, but if you don't start, you're never going to catch up.
Kim, wonderful to get you on the show. Let's catch up soon. Kim Wallace there of 22V. Thank you very much. When are those debates, Tom? Those debates about 2 weeks away for the Republican Party?
Yeah, it's like wait, so
something like 2 weeks today.
Bayern Munich Harry Kane puts on a Bayern Munich jersey. I looked at the schedule. They don't do derbies in Germany, do they?
I'm sure they do, Tom.
I mean, they do. I mean, I don't know any of the teams. I mean, Dortmund.
Yeah, that's one.
Okay.
Bayern's another.
How do I watch German football? I got to get my Harry Kane fix.
Is it on ESPN? I think it might be.
Is it? Maybe this is good for Mr. Iger. You know.
They're going to put up prices of ESPN.
You mentioned it on the conference call yesterday.
I'll confirm whether Bundesliga is actually on ESPN or not in a moment.
We got 8 ways. We got 8 ways to go here. What a joy to talk to Kim Wallace.
Show's crashing and burning this morning.
4 p.m. yesterday. That was historic.
Which one?
The Disney struggle is a huge deal. And as Margie Patel said, can they raise prices? I'm sitting there. I'm wired up worldwide. Mohammed's on line 2, blah, blah, blah. And all I'm thinking is Ferro going to pay the new Hulu fee?
I actually just searched my emails. This was what they charge now. Live TV through Hulu, plus Disney+, plus ESPN+. It's in the 80s now. It's in the 80s. As of the end of last year, I'm sure they put it up again. A month.
They increased it by what? $27 or something insane for both
27%, yeah.
27%, excuse me, for both Hulu and Disney to try to juice the Hulu revenues and subscriber numbers. I personally don't know why the headline isn't, is Apple going to buy Disney? Are they open to that? Because he did not push back.
He was asked about it on the call.
Yeah, and he didn't push back as aggressively as I thought he would.
That's the single smartest thing I've heard in the last
out of my mouth
hours.
Ever.
Without a doubt, it's the single smartest thing I've heard on this show in the first 25 minutes. Without a doubt.
It was a high bar.
Bruce Casman is going to improve on things. Out of JP Morgan, ahead of the inflation data later on from New York. This is Bloomberg. It is CPI Thursday, I'm told, and this is what the market looks like going into this. On the equity market, on the S&P, positive by 0.5%, on the Nasdaq up by 0.6%. When I started doing radio a long time ago, I used to have to get up every single morning and write down the name of the day. Just sort of like, it's Monday, it's Tuesday.
Yeah.
Because when you wake up that early, you lose track pretty quickly, Bramo, of
yeah.
what day of the week it is.
And by Friday, I write down, and I am Lisa Abramowicz.
Yep.
And that's also just to make sure.
The same
way.
person. For the same way. And this is Bloomberg.
Right.
In the bond market, 2-year, 10-year, 30-year. 3-year issue a couple of days ago, no problem. 10-year yesterday, no problem. 30-year supply coming out a little bit later. The 10-year just dancing in and around 4% for the last few days, last couple of weeks for that matter. The 30-year, 417.71, yield higher by maybe a single basis point or so. If you compare where we are now to where CPI last came out, so July 12th, equity market's pretty much dead flat. Bond market at the front end's hardly done a thing. It's pretty interesting, isn't it? So we're all talking about disinflation and soft landing stories, and this equity market is pretty much flat between the last CPI print and the one we're getting a little bit later this morning. Elsewhere in foreign exchange, shaping up as follows in the FX market. Lisa knows where the euro is. It's at 110. 110.22 is basically where it's been for the last couple of weeks, between 109 and 110. That currency pair firmer by 0.4%. Under surveillance this morning, US CPI data due out in about 2 hours' time. Investors looking for further signs of disinflation ahead of the Federal Reserve's September meeting, Tom. Another print after this one. So we get inflation this morning, inflation again on September 13th. So 2 reads before the next Fed meeting.
And 3 reads is what counts to me. I take the 3 months, we could talk to Bruce Kasdan about this in a bit here, but you take the 3-month series and you annualize it. And that's to where I want to be. And it's still... the vector's there, but it's not, you need in the United Kingdom a vector really to come in. Really, there's some real damage there. Here, it's a more gentle disinflation. And the surprise today, maybe we get a curve down where it's a little more than gentle. That would be the surprise.
Big focus for us this morning. This as well, after the close yesterday, Disney earnings coming out with numbers. Revenue and subscriber growth specifically. So subs came in light, ultimately. But cost cutting looks better because of the strikes in Hollywood, partly because of that reason. Then at the same time, you've got lighter subs, Lisa, yet they're still putting prices up in some places by 27%. The stock likes it, but when you go through it, there's a lot not to like here as well.
Michael Nathanson yesterday really nailed this, and I want to just point to that. He basically said this company lives and dies off its parks, and that is what its earnings showed. It showed a complete de-emphasis on streaming, an openness to possibly spin off different things. ESPN had a bit of a problem with respect to not getting the rights to the cricket matches, and they lost a bunch of subscribers from that. So you see something on that front. So all of these are, I think that's Hulu Plus. I forget which platform. I mean, it's all kind of a jumble. But this idea that they're going to raise prices, they are going to crack down on subscriber information sharing. It's basically saying we don't care. We don't care if we grow or not.
You think that's what that is?
It's basically saying we need to raise revenues, and we're not going to necessarily lean into spending to gain revenue share. We're going to figure out, we're going to cut costs, and then we're going to figure out what to do later. I mean, honestly.
It's much, much bigger. To me, it's strategic. It's at the 60,000-foot level. Streaming's been this absolutely brilliant idea, and they don't have scale. That's just, you mentioned Apple earlier. They just, I don't have the numbers in front of me. John, Netflix, YouTube, somebody else is in there, I can't remember, and Disney's way down here. That's all there is.
Well, Netflix is making money.
Yeah.
And they're trying to make money. Subs coming in light and raising prices is a curious one to me.
How else can you read it other than they're not necessarily going to focus on really growing it as much as making it pretty so that it can sell to somebody else?
As Michael said yesterday, they've got the parks, Anaheim, and the rest of it. Is Orlando's still open, right? I don't know what's going on.
He's an expert. He goes to Disney.
Do I look like a Disneyland kind of guy?
He goes on Disney cruises.
No.
The bottom line is it's a busted model. I mean, that's all there is to it. I thought Michael Nathanson is
theme parks are streaming.
Streaming. It's a busted model. Movies, streaming, the whole thing. How do you make a $150 million movie and you don't have Gate at the theater unless you're Barbie? I mean, I just don't get it.
Or Super Mario Brothers.
Yeah.
It's been a pretty big year
I liked
for
it. I saw
movies.
it 3 times.
Mission Impossible.
Been a pretty big year for movies, which apparently are a bust. Elsewhere.
Broken model.
I know. Stock is up by 1.5%. This is an important story. Raging wildfires destroying the historic town of Lahaina on Hawaii's island of Maui. The fires are being fanned by strong winds from a far-off hurricane. More than 2,100 people spent the night in 4 emergency shelters, while travellers from cancelled or arriving flights have been sheltering at the local airport. Tom, if you look at the before and after pictures of this town, since it's been destroyed and what it looked like before, it is shocking, the damage that's been done here.
Take, for example, the Big Island way off to the east, and you've got one idea, which is Kona, coffee, desert, dry, and over to the east you have Hilo, I hope I'm pronouncing that right, which is like a jungle, Amazon jungle. Really cool. All these islands are pretty much the same, and western Maui, away from the Big Island, is dry, dry, dry. I've been to Lanai a couple times, which is 40 miles away, and you look over at Maui, right where those fires were, essentially, you're in a desert, John. I mean, it's dry. It's like a moonscape.
I've done some hiking in Lanai as well. Same thing.
It's like a moonscape.
It's barren.
You've done
parts of it in barren. Yeah. Parts of it are barren.
And the wind gets going, Lisa, and this is not funny.
It's devastating. And the pictures and the images and the idea of people jumping into the ocean and having to be rescued in the ocean to escape the smoke and the fire, devastating.
We'll keep you up to speed on that story, Tom. The latest overnight.
The latest there, and we'll have much more on that through the day. And right now, on inflation, I guess there's no other topic this morning. He's chief economist, head of global economic research at J.P. Morgan. Dr. Bruce Castman joins us this morning. Bruce, I'm putting the time series together. Am I doing it right? Do guys like you and Ferroli, do you take 90 days of data and then figure out a trend? Is that how we should look at the report this morning?
I think to some degree, but I actually would say in inflation data, it's very often that a 3-month run rate is moving in a volatile way around the trend. Remember, the first 3 months of this year, we had really high core inflation. It looks like June and today's July report are going to give us low inflation. I think we're going to have to wait a while on the inflation numbers to get a clear signal of where we're settling. We're clearly coming off where we were last year. It looks to me like we're going down at least into the 3s. But I think the number we're going to get today, which is suggesting something in the low 2s on a run rate, is probably understating where the trend is right now. There's a lot of volatile components, some of which are helping us now, but won't be helping us a few months down the road.
The trends, the first derivative, the slope of this disinflation, does it cause impatience at the Fed, or are they comfortable with the trend?
I think they're getting more comfortable with it. I mean, there's obviously a lot of way to go before we see where we're going to settle, but I think they're feeling better about what they're seeing in the inflation news. They're feeling better, but not that confident that they're getting a labor market which is cooling off and taking some pressure off. And obviously, they are okay with an economy that is growing in that environment, although right now it still feels like the economy is doing a bit more than they would be comfortable with in terms of getting this thing to stabilize.
The more comfortable the Fed gets, the more uncomfortable a lot of people in markets are getting, in particular when it comes to the long end, when it comes to longer term inflation. Do you buy this, that the idea that the Fed is hoping for a soft landing and leaning into that leads to higher inflation for longer as it's being priced into the market?
I think it's appropriate for the Fed to take a pause here and see. I mean, any of us who do this for a living have to be pretty humble in our ability to understand where the inflation process is taking us. However, I think there is a pretty good chance that a pause here does not mean the Fed is actually done. I think labor markets are still tight. I think psychology has shifted here. As I said a minute ago, there's a lot of temporary forces, auto prices, health insurance that are pushing down inflation now. They're not going to be with us for a while. So I'm personally of the view it makes sense to take a pause, but I'm also of the view that it's more likely than not when we look at inflation next year, it's going to have a 3 in front of us at the core number, and the Fed's not going to be thrilled with that.
Right now, I'm looking at market pricing, and it's calling for basically the last rate hike to be at the last meeting. Very little chance of a rate hike next month or the month after, or rather in November, and then cuts starting early next year. Do you think that's plausible? Given some of the momentum, given the idea that we're probably going to see real incomes continue to increase as inflation comes down?
I think to get the Fed to cut in the next 6 months, you need a recession. I think the idea of the Fed cutting requires us to have without a recession, requires a fairly decent amount of time. They get it comfortable that inflation is moving below 3% on a sustained basis. Probably to get that, they'll also need to see some rise in the unemployment rate. That's not my view of where we're going to be. It's certainly possible, but it's not going to happen quickly unless the economy really breaks down.
Right now, we're looking at the various components, the used auto car prices. We're looking at housing prices, rents. What is the key component of inflation that you think is the most important to keep watching? Because everyone has something different.
Can I answer that question with yes?
No, you can't. Try again.
I don't think there's one or even two pieces to this. Obviously, you mentioned a couple. There are a few volatiles here that I think we want to look through: the used car prices, the airfares, the health insurance. The shelter stuff is really important in capturing the trend. It's clearly moving lower. And then we want to look at what the underlying movement in core goods and core service X those factors are, which have been still pretty elevated here and have not yet really shown the meaningful downward trajectory.
I'm going to rip up the script here, Bruce, with the great work you've done over the years on Asia and all. I'm looking at euro yen really at a tipping point right now. Take out the dollar. I got relatively strong euro. I've got the oddity of a weak yen. I'm out at 158. I can't imagine going 160, 162. It's a BOJ proxy. Maybe it's an MOF proxy as well, using the alphabet of the Japanese system. How fragile is that right now? How close are we to a Tokyo tipping point?
Well, I actually think we want to keep both pieces of that cross in mind. So I don't think we're quite there in terms of thinking about a more significant move from the BOJ, but the pressure is brewing. Personally, I think, we should be mindful that as we turn into next year, if the Japanese economy continues to deliver high inflation and strong growth, that we should expect surprises from the BOJ. But the other side of this, and it's the one that puzzles me, is the strength of the euro against the backdrop of the euro area actually looking like the weakest link in the global economy right now. That's the part of the world that troubles us from growth. It's not the U.S., it's not Japan, it's not even China in a major way. But euro area data has been very weak, and it doesn't make sense to me that the euro is as strong as it is.
You're not alone, Bruce. Kit Jukes said it this week.
This morning.
Kit
John,
said the same thing.
This.
Kit Jukes of SocGen asking the same question. Bruce, thank you, sir. Bruce Kasman of JP Morgan looking ahead to the inflation data a little bit later this morning on the FX market as well. Two things. One, Bundesliga available on ESPN Plus in the United States, TK. So
yeah, but it costs me $99 a month
that.
in the bundled package to get it. I mean,
Prices
I guess I can watch the Star
Harry
Wars
Kane
stuff. Andor's in,
Lisa, that was good. Point two, Dan Ives of Wedbush weighing in on what Bramo's got to say, the question she's asking this morning, whether parts of this is up for sale, and whether the likes of Apple might be a buyer. Dan says this: our view continues to be that Apple will not buy Disney, given strategically it would not fit in Apple's ecosystem. That said, we strongly believe if Iger, the board, decided to sell ESPN, this would be a highly attractive asset for Apple. In just a moment from now, we'll catch up with Jessica Reif-Ehrlich of Bank of America on the Walt Disney earnings. Tom, there was this interesting exchange on the earnings call. I wouldn't say that Bob Iger engaged in it, but it was the fact that he didn't push back aggressively against it that stood out for Lisa and others.
Yeah, I agree. But I would say that away from the minutia, and to have Jessica on today is with her experience on this, these are McKinsey-like. This is like the guys in the Patagonia shirts at Sun Valley, that trip we don't go on. The conversation Iger has to have is like a Sun Valley conversation.
Are they Patagonia?
Naval, yeah. Well, no, they're Wagner.
I thought they're like.
I mean, it's like Lisa going to Davos.
Like
she won't.
Brunello vests, aren't they?
Yeah, exactly. They're Cucinelli or Cucci, whatever it is. It's like Lisa and Wagner at Davos. I mean, they're all decked out. And the answer is that's the kind of conversation Iger's having right now. He's not worried about the price of a ticket at Disney World or whatever it is in Florida. I've never been.
You've never been? Never been either. We went to Disneyland Paris once.
Really? How was that?
Ferro clan did.
Yeah.
Not good.
Yeah.
Complained. They sent us free tickets, didn't use them.
Anaheim is...
That's how well that went.
Anaheim
I went
is
once
out of this world.
when I was
Anaheim
5 to Disney World.
Anaheim is the best. It's tiny.
Every time the family went anywhere but Italy, it didn't work out. There was always a disappointment.
And letters written.
Yeah, that's a very Ferro thing, just to, write a letter and complain about something.
All the kids had to submit their letters and see which one was the best.
My mum coming out of there, they're getting a letter.
Framed. Signed.
I think we're in the beginning of a real transition of Disney's assets. I think Disney can work their way out of it by focusing on parks and fixing profitability on streaming. I do think the story is, if you look at the value of resort assets, where they move to, Disney stock is cheap if you think about it as a different type of company led by resorts and hotels and parks.
In many ways, Michael nailed it just yesterday. Michael Nathanson there, senior research analyst at SVB Moffett-Nathanson, going into the Disney earnings. The earnings were better than expected. The revenue wasn't. In between, it was all about the cost cutting. Some of that partly due to the strikes taking place over in Hollywood. They're going to be pushing up prices for subscriptions to various streaming models. Tom, ultimately, they're doing that even with subs coming in light in yesterday's report.
Yeah, I think you're 100% right about the bold nature of the subs coming in light. It was international subs and also United States subscriptions coming in a little bit light as well. This is a joy after Michael Nathanson yesterday and talking to Rich Greenfield from time to time to speak to Jessica Reif-Ehrlich, senior media entertainment analyst at Bank of America, is an honor on this important day for Disney. Jessica, I don't want to talk numbers today. I don't want to talk ratios. Iger wakes up. I believe he puts on his pants one leg at a time. He goes into the office or takes breakfast at some place with avocado this or a glass of pure water. Who does he speak to within Disney about the urgency of a true restructure? Who's he actually talking to?
I think that is a great question because there does seem to be a lack of confidence within the company, given the exodus of executives over the years. And so reportedly bringing back Kevin Mayer and even Tom Staggs should, give Bob Iger somebody with experience to kind of bounce things off of.
But the issue, Jessica, and you've lived this. I mean, you used to go in and Gordon Crawford would shake at Capital Guardian Trust because Jessica was showing up to give him wisdom on this. There was a business model. You made a movie, you made 4 movies for $100 million, and one of them hit big and everybody was happy. That model's been destroyed. What's the Jessica Reif-Ehrlich streaming model that will provide cash flow and profit?
Look, I think they're taking the right steps. I've heard you guys speak about the price increase, which is hefty. There's a 27% price increase for the subscription-only tier at Disney Plus and a 20% price increase for Hulu. Again, subscription-only. The advertising tier is not being touched because the ARPU is higher with the combination of subscription and advertising. So they're kind of forcing consumers into the lower-priced advertising supported tier. So that should help the bottom line. They did say that costs are ahead of expectations, so they'll have more than $5.5 billion in total costs being taken out of the company. A lot of that is streaming. So it's content, it's marketing, overhead, et cetera, SG&A, et cetera. So they're focusing on that. On the content side, they do need to improve, no question about it. And Bob Iger said last night, this is his primary focus.
Well, primary focus in order to grow the platform or in order to prepare it for some sort of spin-off or sale to someone else?
In either case, whether it's keeping it internally or selling or spinning, they need to improve the content. And it's, the content on the platform has to be improved. He said in the past that it's been getting tired. They have too many, everyone's getting distracted. And obviously, the one place where they've really missed is in film over the last, couple of years. And this is his primary focus. They have to fix that film division.
So this sounded like a Bob Iger in retreat, defensive, not really aggressive and offensive, not planning out some sort of expansion kind of plan, but rather really not pushing back against the suggestion of a sale to Apple, either in some of the parts or in a large sum. And you're looking at a situation where people are questioning what the value of the company is beyond the parks. Do you think that it is valid to really characterize this as Disney in defense?
Well, they are clearly challenged from multiple areas. They have secular challenges with the pay TV universe in decline, as do all traditional media companies. There are also cyclical challenges, which all companies are facing. But they have incredible assets. They have incredible branded, unique IP. And so this is, so they're dealing from a position of a challenge position on one hand and a position of strength on the other. And it does feel like, yes, there's some defensiveness because they have to fix what's wrong, and there's a lot that's wrong. but he's also dealing with each piece of it. So whether it's leveraging the ESPN name, with the deal with Penn, or focusing on different parts of the business, they're with costs are growing the subs. On the sub numbers, I know you guys have mentioned that they lost subs, but a lot of the subs are 50-cent subs in India that don't financially contribute.
Right. Jessica, just give me a 3-year vision on who's going to win at streaming on a buy, hold, sell basis. Who's your winner out 3 years on the streaming wars?
Well, obviously, Netflix is doing incredibly well and in a great position. We also think Warner Brothers Discovery with Max, which is really just at the very, very beginning stages, is in a phenomenal position, given their extensive. They don't just have the biggest library; they have probably the best library in the industry. And I think you guys have been a little tough on Disney this morning, because if you add Disney Plus with Hulu, with ESPN Plus, they are well over 200 million subs. So they have a lot going on. But look, there's a lot to fix, and I absolutely agree with that. And it does seem like they're taking many of the steps that are necessary to fix this platform.
Jessica, we're being tough because our subs aren't 50 cents. They're like $80-something a month. Jessica, thank you. Jessica Reef-Erdig of Bank of America. Appreciate it. Tapestry, think Coach, Kate Spade. Capri, think Jimmy Choo, Michael Kors. Tapestry to buy Capri for $57 a share in cash. Are we saying Capri or Capri in America? What are we saying?
I would say Capri.
I would say Capri.
I mean, I think
very American.
But
Okay.
I don't know. Capri. I'm not really an expert.
Although it's out of London, so maybe not.
I assume they mean the island off the coast.
No, I think they mean the
yeah.
pants. It's like the women's pants from like the 50s. Mad Men.
Capri pants.
But it's Capri.
Oh, right. Capri.
I would call that Capri
that.
too.
Okay, nice. All right, Capri.
Okay, this thing is 6%.
Well, let's get to the news, Tom.
Well, Tapestry, John, Tapestry, which I hate. Coach, which invented the leather belt, frankly, in America a million years ago. Coach is, well Capri, let's go with that. Capri is 6% the size of LVMH.
Yeah.
So this is a bolt-on for LVMH, a bolt-on for Tapestry, whatever.
But the point of this is exactly because LVMH is so big, because Kering is so big. How do you compete with some of the giants that have really gained increasing prominence? Hermes, like all of them have been doing so well this year, in part because of scale and scope as well as the selectivity. So I wonder, Jimmy Choo and Versace, okay. Michael Kors maybe a little less so, since that's more, that you see.
Coach has no place in a conversation about LVMH, does it? I mean, come on.
No, that's the
but they're
point.
trying to. That's the whole point, is that they want to, if you're talking about Versace.
I think the team at Bloomberg Intelligence is really good on that. We bundle luxury all together because they're all in the same 4 blocks on Madison Avenue. Farrah's there every weekend. And the answer is they're not all together. There are 3 or 4 big winners. Kering owns 6 companies. Right. John, you know better than me. But the answer is there's stratas of luxury, and they're buying a train wreck. $52 a share gets them back to my long-term moving average price decline of Capri. I mean, the thing has been a 10-year train wreck, to be direct about it, and they're putting them out of their misery at a center tendency right now of 52-ish.
$8.5 billion deal.
Yeah.
Tapestry's down in the pre-market by a little more than 5%. Look at Capri. It's running pretty hard off the back of this deal in a pre-market, Lisa. Absolutely surging.
I just wonder, okay, yes, obviously they're getting bought out at a higher valuation than they were previously valued for. I wonder how important it is to have scale, how important it is to have the dominant figure in an industry. For the luxury brands, how much LVMH, how much Hermes, how much Kering really benefited from their size during the push and pull of the pandemic. And that, I think, is really the key question underpinning a deal like this.
Don't you think Capri just sounds.
Oh, no, John, you're dead on.
Yeah.
Sounds better.
Than Capri. I mean, it's Capri.
No,
Capri?
You're right, John. I agree.
Wait,
but they're out
Why?
of London, so for all I know, they got the
I've got no
Ferro thing
idea.
going.
Capri.
Find out. See if they want to come on air and chat luxury. I doubt it.
Tapestry.
That pronunciation.
Based on what we just said about Tapestry, maybe not. Evan Brown of UBS is coming up. Big day for luxury. Need to talk about China dropping some of the curbs around international travel and what it could mean for Chinese tourists to the United States. We'll talk about that in the next hour from New York. This is Bloomberg.
Everybody's improved on sentiment, but the data is not telling the same thing.
The economy has really shown that it has been relatively insensitive to higher interest rates so far.
Strong wage growth is causing inflation, but it's a barrier to lower inflation.
I wouldn't be surprised to see the Fed go another 25 or 50 basis points.
I think by the end of this year, the economy starts to go into a mild recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
The mics are hot now, TK. Live from New York City this morning. Good morning for our audience worldwide.
Oh, for 24/7 Bramo.
This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. It wasn't Lisa this time. In your equity market, we're positive here by 0.5%. Inflation data in America about 90 minutes away. That's the big story of the week, Tom. It's the big story this morning. It is about 90 minutes around the corner.
It really falls into everyone, and I think for our audiences in radio and television, there's a global Wall Street audience that's looking in the Bruce Kasman world about what will this do, what will that do. Mostly it's a nation exhausted by inflation. Granted, nothing like Europe, nothing like the United Kingdom, but this is a nation exhausted by inflation of, say, 5% with wage growth of 2 or 3%, just as a talking point, the spread there, the difference. And the question to me, and maybe to Jerome Powell, is exactly when is this over?
How much pricing power is left? I think it's a really important question from company to company. It's a question we're asking of the Walt Disney Company, Lisa, who in some places putting prices up by 27%.
Even as subscriber numbers come down. So it goes to this question of, are people pushing back, or are they just basically capitalizing on the people and their diehard fans? There is a question of which areas can have pricing power and whether people will keep paying for it, and whether this is this rolling wave of inflation that can keep reaccelerating. And this is what Andrew Hollenhorst over at Citigroup thinks. Basically, risks around core and headline inflation switched to the upside in August, and risks are growing if a sustained acceleration into 2024.
And the pricing power thing is really germane. I mean, Margie Patel and Jessica Reif-Ehrlich from two different worlds both said Disney can pull this off. Does UPS pull it off? If they're going to pay John Farrell $170,000 to deliver boxes off a brown truck, do they have to raise the price of my UPS box? People are going, of course they'll do that. Says who?
I had a lot of people come up to me in the last 24 hours inside the building saying, where do I apply? $170,000 to be a driver at UPS
I know,
in
but
5
the
years,
whole
a lot
thing
of
here,
money.
we're in inflation. It's above 2%. We had this gift for 15 years. Who's going to pay for it? And the answer is there'll be less tomatoes in the can. That's a cliche.
Make
or
it
you
smaller.
raise a can of tomatoes.
Shrinkflation.
Yeah.
It's a big deal.
It's a big deal.
It's a big deal. Here's another big deal, an actual deal. Tapestry to buy Capri for $57 a share.
Nailed it.
Thank you. I had to think about it. I'm going with Capri.
This is busted luxury. I don't care what anybody says.
This is Coach having a look, Tom, at Michael Kors, right?
I'm on Madison Avenue. I go into Michael Kors. What do I see? Who's Michael Kors? I don't know.
He was the judge on Project Runway.
Pretty brutal assessment here, Tom.
No, I don't know. I don't.
What's Coach these days?
Come on, there's different luxury. We talk about LVMH, John. You're encyclopedic on it. We talk about Celine. We talk about Hermes, we talk about this, that, and the other. Are these names in that same category? You mentioned it earlier. I don't think they are.
They're not.
Yeah.
Well, what about Versace, Jimmy Choo?
Versace's up there.
Yeah, so some of them are. I mean, this is the question, is they are going across a range of different fashion outlets. Michael Kors does sell in a lot of the, department stores and discount stores. A little bit less so with Versace. So, they're trying to get a conglomeration here when size matters.
Capri also manages money on the West Coast, I'm told.
Ridiculous.
Just got that message.
Really?
Bloomberg subscriber.
Well,
they're entitled to have a voice on this program.
They're probably from London.
No, that's a US-based investor.
Capri?
Okay. No, the person who sent the message is a US-based investor. Anyway, Tapestry's down by a little more than 4%. Capri is higher by something like 50% this morning.
The names we're talking about selling 30 times PE. Hermes, the rest of them. I didn't know this. Tapestry's, I'm going to be charitable, 12 times PE. They're not comparable. I mean, we say luxury for all of them, and they're not.
We're talking premium high street. Can we call them that? Sort of premium high street? Coach, Kate Spade, Stuart Wiseman.
There's Bond Street. There's like two Bond Streets.
We'd call that.
There's Bond and there's New Bond.
Then there's the high street. in the UK. Okay, let's get to the price action. Equities, never doing that again. Equity futures on the S&P, positive by 0.5%. Yields a little bit lower, Lisa, here on a 10-year by a single basis point, 399.73.
It's CPI Thursday, 8:30 a.m. The numbers drop. Very curious to see core, very curious to see the interpretations and the market response. Arguably, that's the most important thing to me at a time when you do expect disinflation. The key is, are people going to take this and run with a soft landing type of narrative? 1 p.m., the U.S. is selling $23 billion of 30-year bonds. The auction yesterday of 10-year notes went fine. The auction the day before of 3-year notes went fine. 30-year is more key at a time when people are expecting the Fed to pause, and then this question of a reacceleration in inflation.
Do the same people buy the 10-year that buy the 30-year at auction, or are they different beasts?
Some of them, but there is a different audience for a whole 30 years out, and it is a smaller audience than the ones for 10-year, which is more of the benchmark note. We will be watching that, and we will be hearing the interpretations from Fed speakers who have been prolific in their comments this week. Atlantic Fed President Raphael Bostic and Philadelphia Fed President Patrick Harker.
It's just Harker and Bostic.
It's basically them. Just
we make jokes. We make jokes about this,
with a bit of Barker.
But John, they have a mandate, and this is the time of year where across, say, they have 5 states within their district. They've got to go out and talk to people. That's part of the act. So it's not like they don't have a speaking agency saying, "Can you do Des Moines Thursday?" They're like they have a formal mandate to speak to the business community.
The local Chamber of Commerce.
Yeah, Rotary. It's taken seriously.
Sure.
Yeah.
We take it seriously too. I talk about these speeches all the time. You take it less seriously.
I think they're over-communicating, but at the same time, they have this mandate to communicate within their districts.
Okay. Evan Brown joins us now, head of multi-asset strategist over at UBS Asset Management. Evan, the data a little bit later this morning. Do you have any reason to believe the incoming data between now and the next Fed meeting will challenge the soft landing narrative that this market has quickly embraced over the last couple of months?
Yeah, I don't think so. I mean, we're not only seeing resilience in the U.S. data, but we're really seeing a broadening out of the surprises. It's really across the board. Labor market's still resilient. Consumer confidence picking up. We know housing is in good shape. Manufacturing is hanging in, and inflation is coming down. We know it's going to happen because of shelter and used cars, and we're starting to see some progress on core services ex housing. So I think the Fed wants to pause here, and I don't know that we're going to see enough data to suggest a hike in September.
Evan, within UBS Securities analysis, do companies have pricing power?
Well, I think we're seeing some moderation in wages, outright on the aggregate level. And I think what's really encouraging is last week we had that productivity data, which was quite strong, and unit labor costs coming in lower than expected. So, that is a Goldilocks situation where people can still get paid and companies still have decent margins. So we don't see a ton of evidence to suggest that margins are compressing a great deal.
What is the rate right now to companies and business? Is it the nominal rate you're focused on, or is it some form of inflation-adjusted rate that matters for the corporate spirit that drives the stock market?
Yeah, in the end, earnings are nominal, right? So that's the bottom line. That's what we've seen over the course of the last year is that even as inflation has been high, companies have been able to push that on to consumers, and we really don't see much evidence that that's going to switch anytime soon.
There is a question, though, about whether the big tech behemoths have really kind of gotten overblown over their skis in terms of valuation, over their skis in terms of the promise of artificial intelligence and some of the other technologies. Are you in that camp, especially after what we saw yesterday with a bit of, a cooling off, jitters around the artificial intelligence story?
It's reasonable given the run for there to be some consolidation in this AI story in the mega cap tech areas of the world, and so that's why we want to focus our positioning on the more cyclical areas of the market. Industrials, energy, financials. We just see more upside there. We don't want to outright short tech because this AI theme. How do we know how to price it exactly? But we want to be overweight on other areas of the market.
When you do see a consolidation in the tech sphere, at what point do you find it attractive again?
Well, we want to see a little bit of just kind of moderation in valuations and a slowdown in the pace of appreciation. As long as the earnings and the earnings outlook are coming in okay, then eventually you'll grow into those earnings. So let's see first this continued repricing of cyclicals higher, and then with some consolidation in time and perhaps in price later this year, we might think about getting more involved in the tech sector.
Evan, can I just squeeze in a question on the FX market as well? We had this conversation the previous hour on Bloomberg TV. Just why isn't the euro weaker? Evan, why isn't it weaker?
Well, I think it's because they still have an inflation problem and the ECB still has to stay hawkish. I mean, yes, European growth hasn't been great. We know that. But in the end, it's rate differentials. And rate differentials are not moving aggressively in favor of the U.S. because Europe still has a core inflation problem. We're not seeing the same progress yet that you are seeing in the U.S. And also, there's been a decent negative correlation between risk assets and the euro or in the dollar. So euro hangs in as long as risk appetite stays reasonably robust. And perhaps later this year, we get a turn in manufacturing globally, and that can provide a little bit of support for the euro as well.
Even as China underperforms, Evan?
Yeah, I mean, I think the China story is broadly known at this point, and a lot of that bad news in China, the China growth story is priced in. So, consumer getting, even on the margin, a little bit more confidence in China. And we're seeing, the price action in European luxury, some of that today, I think, is a result of reduction in travel restrictions in China. So these marginal steps on policy, I think, can help brighten the euro story as well.
Evan Brown of UBS. Evan, thank you. China allowing group tours back to the United States and the UK. The US, Tom, has been a soft spot for earnings for the likes of LVMH. Richemont as well. You've seen that in the earnings reports. Can that turn around on that declaration off the back of this travel story in China?
We all got our stories on this. Mine is I'm in Venice, and I'm at one of the stores. I think it was Gucci. I can't remember. And there's a guy next to me with 3 cell phones.
Taking orders on the cell phones. This is what we got. And that's not the punchline. The punchline is 10 feet away. There's another guy doing the same thing. And that's what's missing. And you're being ignored at the same time.
Completely ignored for my puny little, I think it was a scarf. But yes, precisely. I was being ignored. But
you're not spending the money.
But the point here is that's really what we're talking about, is the commerce that comes from that tourism.
If you're just tuning in, welcome to the program. It is CPI Thursday. Your equity market is positive by 0.5%. Peter Cheer of Academy Securities is going to be joining us a little bit later this morning. We'll catch up with him in about 47 minutes' time. Tom, I'm with you. I get ignored in those stores all the time.
Yeah.
All the time.
Yeah, Kriti Gupta just out with a brilliant note briefing me on all the different products that are involved here. I don't know the names. But these aren't luxury. Kriti leads with these are luxury companies. And I'm like, says who? I don't think they are.
Can I tell you, it scares me when you walk into a store and there are only like 3 shirts on the rack. Like, that scares me. Because you know what I mean?
What store is that?
Like, just if you go into some sort of clothing store and they have, just 3 shirts and everything's just sparsely kind of populated with their products, but it's more just sort of like a show.
Oh, it's a look.
Case.
The stuff's out the back.
Right. But that scares me always.
Oh.
It's
what
like,
drives me
precious
nuts
and
is how you have to line up outside
prices. Now. That is ridiculous.
I go. My guy
I don't
Andrew.
do lines. I refuse to. I
I refuse to. I go up. I go, is Andrew here today? And they go, yeah, he's here. Good. I need a damn bow tie. That's it. And if they don't want to let me in, I don't go.
Make an appointment.
Yeah, right.
Don't line up. Don't do that Soho thing. I hate that thing at Soho. Just can't stand that thing. Lines around the corner for a store. What's that about?
Nixon was president the last time I was in Soho.
Seriously?
You and I have gone for lunch there. What are you talking about?
That was Soho? I thought
yes,
that was Tribeca.
Was. No.
Oh, I thought everybody wore black.
Tribeca's even further down.
No, I thought everybody was wearing black, so I thought it was Tribeca.
No, Tribeca is below Canal Tom. We were just south of Houston. Soho.
It's Houston.
Soho.
It's Houston?
It's Houston.
I didn't know
Soho.
that.
It's Houston.
Capri.
This is going well. Henrietta Trays of Veda Khan is coming up from New York. This is Bloomberg.
The core of that report was the U.S. is behind in investing in self, and it's behind in paying attention to China and other competitors who have locked out green technology and other technologies that are necessary for the future. And so, yes, when you're the reserve currency of the world, you have to step lightly. But in this case, the president has chosen to step firmly in terms of strategy.
Kim Wallace there, the head of Washington policy research at 22V Research, on the latest outbound investment restrictions coming out of the White House on China. Your equity market going into CPI, equity futures positive on the S&P 500 by 0.55%, Tom. We have a deal, potentially, between Tapestry and Capri Holdings.
You're all over this. Yeah.
Capri's up by 58%.
I'm going to laugh every time you say it.
The latest news this morning, Tom. A deal. Tapestry's down 3%.
Yeah, this was rumored, I guess, and there it is. And it's within, can we agree that the sluggishness of most of luxury? I mean, is Michael Kors popping it in China? I don't think so. It's not like the bigger luxury brands where they're truly international. Am I right?
$8.5 billion deal, Tom, and potentially more to come based on maybe the rationale for this one, or others going to follow.
I don't know, but today, am I right that the other luxury makers have had a nice 1-2% pop off this travel loosening rumors in China?
So basically,
it's fluid.
They're not rumors, they're changes. So there are changes around group travel abroad. They've been doing this in groups of countries over the last few months. And Lisa, the latest group includes the US and the UK. We know domestically in China, travel, tourism, great. International, not so great. We also know that based on some of these restrictions being removed on some Southeast Asian countries, that actually travel there hasn't snapped back. So let's see if tourism out of China into the United States actually does snap back as they allow these so-called group tours to return in the US.
It's part of a broader softening, though, in a lot of stances by the Chinese government as they try to shift their stance a bit to encourage growth. So it makes people feel like maybe they want to encourage more trade, maybe they want to encourage more of an outreach in order to foster a bit more momentum.
Here's the message. Stunning silhouettes. Prepare for an exhilarating style journey that defies convention. Brace yourself for a captivating, I think it's voyage is what they say.
Is this a group
voyage
tour?
Where boundaries are shattered and personal expression reaches new heights. That'll be $6,000.
Is that $6,000?
I would assume. What I'm looking
that?
at, I'm probably lowball. It's one of the fancy luxury companies preparing me for my journey with silhouettes.
Oh, so that's not a group tour. That's not a travel operator.
No, this is real luxury.
What's the brand?
It's Hermes. Stunning silhouettes from Hermes. Find the perfect match.
Bramo's sitting back for once. She's done.
I am
but that's
so done.
real luxury. They're preparing
I
me
just
for
wear
a
the
journey.
same thing every day.
Basically, you want to sort of say Michael Kors is not real luxury.
That's what I'm saying.
Okay,
it's not. And
it's out there now.
Bloomberg Intelligence is really good on this.
Can we move on?
Okay.
The media bundles them all together. We
Coach
don't do that.
either.
Neither does
No.
Henrietta Trays.
Okay.
Henrietta Trays, Economic Policy Director, Research at Veda Partners, joins us right now. We talked to Kim Wallace earlier, which is great because you got legit international economics there. And with Henrietta Trays, you've got piercing domestic policy analysis. Excuse me. Henrietta, what do the Democrats do on Capitol Hill to advance Bidenomics?
Well, first of all, let me just say I wish I'd dressed better for this segment because I am just beyond at Hermes, I think we're calling it now. So what are the Democrats doing to advance Bidenomics? I mean, I think right now what you're seeing is them canvassing across the country and really watching to see, most importantly, who is coming out in the Republican Party on the Senate candidate side and how they can run an economic agenda against them. So far, it's turning out to be pretty easy, and they don't even really have to focus on economics yet, as the votes in Ohio earlier this week showed. They can talk about abortion issues and get the turnout to be through the roof. They can run against Carrie Lake, it looks like, in Arizona, which is going to be sort of a Trump versus Biden and sort of mainstream politics. So the Bidenomics message is something they're trying to get out there, but they haven't had to really yet.
When you're wearing your Hermes in all the bars of Capital City and you're getting pulsed up here for the debates, the primaries, the election, Henrietta Trays, the phrase, it's the economy stupid, I've never agreed with. Is it the culture war stupid? Is that really where we're heading?
You know what it is? It's abortion, stupid. Do not come for abortion. I mean, Roe v. Wade and the Dobbs decision was the worst thing Republicans could ever have done. They woke up a beast. It is all age brackets. It is a turnout machine, and they're losing hand over foot. And I don't see any way that that's going to change, especially since Republicans keep poking the bear. So I think that's really the message. It's not the economy. It's abortion.
That message on the national stage isn't going down well. What about in the primaries, Henrietta? What do you expect to hear in the debates later this month?
Well, the debates this month are obviously all going to be on the Republican side. And I think Ron DeSantis is the one that every candidate is going to try to beat because Trump may or may not show up. If Trump is not on the dais for those debates, you're going to see Ron DeSantis just get slammed by every single candidate, from Nikki Haley to Tim Scott, on down to Mike Pence and Chris Christie. They will bring up Trump occasionally, but the person to beat will be Ron DeSantis. He's already tanking in the polls. He was at 30% at the beginning of this year. Now he's below 15. That is a death spiral. Campaign shakeups, et cetera. I have a friend ask if we're going to have a watch party for the November 8th DeSantis Newsom debate. And the question is more, is he still going to be one of the front runners in the race after these campaigns and after the debates at the primary side? I mean, their position on abortion is just as far to the right as you can get, and they just drive each other further, which alienates the entire general election base.
So if it isn't Ron DeSantis, who is the front runner? Is it going to be Tim Scott? Is it going to be someone who's not even thrown their hat in the ring yet, like Glenn Youngkin?
I think so, Lisa. I mean, there is a deadline of November 16th to get on the ballot in Nevada. And I think that that's a key deadline to look for. I think the money that has gone to Ron DeSantis could easily start flowing to another candidate. I do agree that Tim Scott is the next most likely, but he polls at 3%. So really, Glenn Youngkin or any of the other governors could step in. Sununu, I know you is a frequent guest on your show, and I'd be interested to see whether or not he decides to change his mind in the wake of the 4 indictments, or 3 now, but 4 becoming against Trump, and DeSantis maybe not being the second runner-up.
There's been a belief construct, Henrietta, which you have studied for years, going way, way back, that the United States of America will always grow itself out of its debt troubles. Is that shaken right now? Is that foundational belief shaken?
I don't think so, because the appetite globally for debt just keeps expanding. And I don't think that's a U.S. specific problem. And perhaps to be more honest about my answer, Tom, I don't see any lawmakers sincerely putting in the effort to reduce the deficit. So I don't think that debt is something that they're really going to look in the mirror and say, hey, maybe we shouldn't extend the 2017 tax cuts for individuals beyond 2026. They're going to. They always do. We saw that movie in 2010 and again in 2012. It's going to wrap up the deficit substantially, $2 trillion just for those tax provisions. And I don't see any real conversation until we get into a maybe untenable place with Social Security.
Henrietta, I want to finish on China, if we can. The Biden administration, as you know, have put out their outbound investment order. The president has signed that. Here's the question for me. It's super narrow. China says we're disappointed. I'm trying to work out if it's just to say, A, we're doing something, and B, we're disappointed, but actually nothing really changes here. Is this just for public consumption, or is this meaningful?
You know, it's such an interesting question, and I was actually thinking about this before I came on the air. Last week, Lisa, and y'all, we were talking about the Fitch downgrade, and one of the questions you asked was, is the business community responding to what Congress is doing, what the administration is doing on the debt, to bring in Tom's question. And what's interesting about this investment executive order is that the business community is already ahead of it. If y'all had a great chart yesterday, I guess, on venture capital in China and how it's declined since the COVID era. It is a precipitous rise after 2019 and an immediate fall. And that's on the venture capital side, obviously with Sequoia, but you probably get in the same kind of thing in the data on business side as well, where you have the Russia sanctions, export control restrictions. To sort of get to that question, the business community might not be afraid of Congress and what it's legislating, and maybe not this executive order, but for damn sure they're focused on the Bureau of Industry and Security and the Treasury and the IRS and the efforts that they're going through to put sanctions, export control restrictions, investments restrictions. The entity list is going to be updated. Those are real, tangible meat and potatoes things that businesses have to respond to. And I think they are working, maybe just better than the timing on an EO.
Henrietta, thank you. Henrietta Trays there of Vader Partners from New York. Inflation data an hour away. A two-day losing streak on the S&P 500 going into CPI 60 minutes away. In the equity market, equity futures positive here by 0.5%. On the Nasdaq, we're up by 0.6%. In the bond market, the 10-year hasn't had a close below 4% all month. The month is young, I know, it's only August 10th, but still in at around 4% again on a 10-year. Yields going nowhere. On a 2-year, 479.75, yields lower by a single basis point. On a 30-year, look out for supply a little bit later. Some more 30-year bonds coming to market later on this afternoon. Your 30-year yield, 417.31. Talked lots about the FX market. Let's finish on the euro. Quick check of what's happening in G10. The dollar weaker here against the stronger euro. The euro against the dollar here, Tom, 110.25. Positive on that currency pair by 0.46%.
And not to waste time here, but euro-yen, I think yen dynamics here. Bruce Kasman was just brilliant on this earlier. And the idea of you triangulate three currencies, not a currency pair, but a currency triangle. Take out the dollar, you got euro, yen. He was focused on euros. You've been focused on the mystery of why euro's at 110 versus, say, at a 105. But the bottom line is the screen, the Bloomberg terminal's telling me we're at a tip point on euro-yen.
The euro is stronger this morning. The dollar is weaker against everything in G10 with the exception of the Japanese yen. Under surveillance this morning, US CPI data due out in about an hour from now. Investors looking for further signs of disinflation ahead of the Federal Reserve September meeting. Are you getting any disinflation in New York City? New York City apartment hunters could be reaching their limit. Rents in Manhattan, Brooklyn, Queens hitting new highs in July, but leasing volumes declining, signaling that the renters may have had enough. I can tell you we'd had enough a long time ago. The median rent now in Manhattan, $4,400. Elisa, that's up for 2.3% from June. Rents jumping 11% in Brooklyn, $3,950. Just amazing.
I love how personal this story is for you. Not that I love that you're, struggling with the prices, but rather that, this is where you gravitate toward. And then you're going to start in, if I could only go back in time and lock in low interest rates and buy a home and be paid to buy a home, that's going to be really important. And this is where we're at. At what point do you have, yes, pushback, fewer leases, but at the same time, they're still paying the prices and the price is still creeping a bit higher?
Tom, $4,400.
Yeah,
for an apartment in New York City.
What I take,
nuts.
They do. Jonathan Miller does a great job on this at Miller Samuel and all that. But I wish in the article they equated that to how much money do you have to make to buy that studio? The place I live, the 6th floor walk up I live on, is a studio popping at $4,200 right now, which is basically a closet with a window. And the basic idea to me here, as I mentioned the other day, is the economist Carrie Bradshaw index. Carrie Bradshaw was an economist at LSE. And Carrie Bradshaw index is what is the median wage?
Sure.
Yeah, she's exactly.
Okay, let's go there. How did Carrie Bradshaw afford that apartment and all those shoes?
It
made no sense at all.
Yeah.
It made no sense at all.
It's the fantasy of it.
She was a columnist for some random New York paper.
She was good.
And she was buying thousands of dollars worth of clothes every month.
John,
stop asking questions. These aren't the point.
She refied the studio apartment off the Manolo Blahniks. I mean, that's how she did it.
Carrie was a terrible human being. She really was terrible. It's amazing that people are starting to figure this out 20 years later.
Stay with us. Don't go away.
Yeah, exactly. How do you really feel? What was the biggest, most offensive thing that she did?
When her friend got married, and she came out and she put that Post-it note on top of her hand because she'd had a tough go of it with a new boyfriend. Come on, they got engaged and she wasn't happy for them. Dreadful. Dreadful.
Hot take.
I'll tell you what I really think.
No kidding.
All right, another time. Let's get to this really important story developing overnight.
No idea what you're talking about.
In Ecuador, presidential candidate Fernando Villavicencio assassinated less than 2 weeks before the country's elections. He was shot while leaving a rally, the government declaring a 60-day state of emergency. This individual, Lisa, you might be familiar with him, well known for unveiling corruption in government in his country. Of course, death threats coming from various parts of the country, including the mafia. I was looking at some of the death rates across Latin America. In Ecuador, it is shocking how much that's gone up.
They have more homicides per capita now than Colombia, which traditionally had the serious cocaine problems and some of the cartels there. This candidate was a longtime journalist who really said he was going to crack down on these cartels. Yes, he got death threats, but he said, no, we need to repeat what some of the other Latin American countries are doing where they really crack down because the amount of the assembly of the cocaine cartel has just been out of control.
My amateur take on this with a quick read, and I defer to people like Shannon O'Neill at Council on Foreign Relations and others, is I'd watch El Salvador. It's interesting to see the hot spots within always troubled South America, El Salvador, the others, the mafias, the cartels, whatever it is. And the solution in El Salvador is basically almost like a Hungry John Eastern European solution. Let's get tough.
And the president is the most popular in Latin America for rounding up cartels. And people say he's very authoritarian, but this is what people are now going to look for in the hard line that you might see the shift in Ecuador in response to this.
John, I have no idea, John, where Europe comes from this, but I know in America we are so biased by our childhoods of looking south across the Caribbean to South America, that I don't think I think clearly on this other than the tragedy of a journalist gunned down today in Ecuador.
I think we're all familiar internationally, Tom, with Colombia and Peru being hubs for cocaine production. Ecuador sandwiched in between. That wasn't really part of the conversation until recently. I was going through our story this morning, and thanks to the desk overnight for putting this together, the murder rate there soaring by more than 300%. Over the last 5 years. It's got dangerous really quickly.
Yeah, I mean, I just think it's really, really serious point. We'll have full coverage on this through the day as well and into the weekend as Ecuador adjusts to an assassination. Right now joining us, Megan Robson, head of U.S. credit strategy at BNP Paribas. And that's a really, really interesting fixed income position because BNP Paribas has been outstanding over 20 years of a measured view of economic growth and how the markets would react to that. How do you dovetail Kyle Riccadonna's world and an inherent BNP Paribas economic caution into the fixed income market? How do you adapt to that?
Well, thanks for having me. So we expect growth to slow, and we're expecting we are in a growth deceleration heading into CPI today. We expect that inflation will be low enough or good enough for the Fed to be on pause, and credit markets are pricing in only the positives around that. So if you look at credit spreads, we hit new tights at the end of July. Credit is pricing in all of the benefits of lower inflation without some of the risks of how that process plays out or that process potentially takes longer to play out. So for example, during second quarter, revenue growth typically tracks very closely with CPI. We've seen revenue growth now hit 1% to 3%. So we're approaching that 0% level of revenue growth.
This is the BNP Paribas heritage. I'm going to go to Marty Fritzen, the great default guy on this. Are we underplaying credit risk? And I don't mean gloomy high yield credit risk, but even credit nuance in the middle of the investment grade area.
I think investment grade, so growth has surprised to the upside. That is undoubtedly a positive. And I think that we are seeing deterioration in broad fundamentals, but for investment grade, fundamentals are still generally pretty healthy. So as an example, a year ago, interest coverage was 13 times for the investment grade market. That has come down over the last year to about 11 times, but still quite healthy. The places where we're more worried and where we have seen distress played out are the most interest rate sensitive parts of the market. So two examples where we've seen defaults start to rise. One is small and medium business enterprises. So companies that don't necessarily have publicly traded credit, but our public companies, our private companies, very small, and those are most sensitive to rates. So it's not surprising to see that bankruptcy filings have climbed higher there. And then also in the leveraged loan market. So leveraged loans, obviously floating rate exposure. Over the last 3 months, and I know, Tom, you like to follow the 3-month statistics on an annualized basis.
Nailed it.
If you take the 3-month loan default rate and annualize that, you get to a 5.5 or 6%
There's
level.
a gloom we need.
Well, is the public market less important than it used to be? Is sort of the metric that we look at when we look at spreads less relevant to the reality on the ground for all of the big investment firms that are increasingly moving private?
It's a great question. So I think that private credit is definitely going to play a role in this cycle, and things will be different. A simple but I think very relevant framework to sort of identify problems in any cycle is to follow the debt growth. And if you look at debt growth in private markets, it has outsized that in public markets, and it should point to there being issues there. There has been growth in public markets as well, but not as extreme. So I don't think that private markets will be immune from this cycle, and we will see some problems in that area as well.
Do you think that it dulls the sort of tea leaf reputation that credit used to have, that it was the canary in the coal mine, because there is this huge buffer of debt that's in the shadows that you can't really see engage in real time, and that kind of underpins some of the credit quality in the more established companies that we trade publicly? In other words, it's not a leading indicator anymore, is it?
So spreads are certainly not a leading indicator. As we hit the tights in high yield spreads, we're trading below 400 basis points. That market would be telling you there's no problems ahead. But I do think there's other areas of credit in the public market that are signaling a recession or problem. So if you look at the primary market, the very low share of CCC issuance is telling you, and is in line with what you've typically seen in a downturn. Another example would be the rise in secured bond issuance in the high yield market. So I do think public markets are telling you signals, but it's not the typical sort of CCC, very gradual widening from the rest of the market.
Sometimes we become desensitized by news elsewhere, just hearing it on a continuous basis. But should we be worried about what's happening in China with property developers?
So China, we have seen stress in China over the last few years. I think that from a demand perspective, it is going to impact our growth outlook and our growth trajectory. We're already in a deceleration, so I do think that following China will be important, and also from the perspective of stimulus and how much liquidity is pumped into the system, it will be very relevant for our demand and liquidity outlook.
Megan, thank you. Megan Robson there, BNP Paribas, the credit market. Lisa, it just seems that property developer after property developer getting into a little bit more trouble over in China.
Yeah, the latest being downgraded to what, CCC? By one of the rating agencies this morning.
Just
after cut as they don't pay their interest payment. They're in the 30-day grace period. There's going to be evidently some sort of meeting that China's holding with some of the property developers to try to shore up something. What does that look like?
I want to be clear to our audience that we don't equate this to what we see in CRE in New York or other major U.S. cities. This is a uniquely China massive development marketing kind of company like Evergrande. It's been widely anticipated over the last number of days.
If you're just tuning in, welcome to the program. The S&P 500 positive here by 0.5%. Counting you down to the CPI report. We've got a clock up. We do. Look at that, TK. 47 minutes away.
I thought that was Harry Kane's clock to when he announces he's going to
Now he cares.
We haven't had an official announcement, have we?
No, we haven't. I thought you put that up just to bust my
reporting coming
chops.
out of The Athletic that the club has accepted.
What does Sun do? I mean, the Sun's coming down the field and there's no Harry. I mean, how does that work?
Sun is going to be upset because he misses Harry.
So he'll leave.
Sweet.
Is
No,
that
I
the
don't know if he's
theme?
going to leave. I've got no idea.
What have they done?
Leave.
They're like the Red Sox last year. I get all these teams. I can't keep up.
Tom, you support a terrible team.
Thank you. See the love here?
Which one? Did you say that
Who do you
Red Sox?
support in English football?
I'm going to take the fifth on that one.
You're supposed to say PSG. You work for BNP Paribas. Every answer is
Paris
PSG.
Saint-Germain. That's
Thank
true.
you.
That's true.
See.
Yeah.
See?
You okay
Did you say C?
He's learning.
Did you say C?
No, I think he meant S-E-E.
Oh.
Like C.
Sorry, I just thought, I don't
You
know.
want to talk about
Things are
tourism?
going off the rails.
You
today.
want to talk about tourism? This
Sure.
hotel I
Let's
stayed
talk
in
about
Paris
tourism. Why not?
It's
Let
lovely.
me tell you.
I called the hotel the other day, and the guy goes, "Mr. Keene, you literally can't walk down the street. There's so many people."
Where?
Paris.
Oh, right.
You
okay.
can't, it's a narrow street in the Seine.
Was he trying not to get you to come?
It's like
He's sold out. He doesn't
China.
care.
John, I just looked at a trip to Shanghai. You ready? United Airways, 2
How much?
people. It's $40,000 with the taxes.
I'm sorry. What?
40.
40
for one ticket.
That's what it costs to come
Where
out of Newark to
is that
PVG.
for the whole plane?
No, that's 2 people sitting in business class.
2 tickets.
Stop it. 20K each.
$39,000. That's what it says. 2 people.
That's insane.
We think that the market's fair valued where we are right now. I still think that there's some risk in this market in the sense that we think you're going to still see a mild recession unfolding. And right now, I think everybody's just getting overly optimistic on both the equity market and the economy. And I don't think that's warranted because, like I said, there are some signs that we're looking at that still point to a recession by the end of this year.
That was Larry Adam, the Raymond James CIO, on this equity market.
He was on fire yesterday.
Going into some important inflation data a little bit later this morning. Expected to show further signs of disinflation beneath the surface going into the Fed's meeting at the end of September and just before the Jackson Hole Symposium, the little get-together of Fed speakers, economists and people like us. Equity futures on the S&P 500 are just about positive into all of that by 0.4%. The 10-year yield, as it has been over the last couple of weeks, Tom, in and around 4% and basically unchanged on the day. Bit of dollar weakness out there against G10. The euro firmer here by 0.5%, 110.23, Tom.
Yeah, well, there it is. Are we getting used to 4%? I'm sort of finally getting used to it.
2 weeks of it.
2 weeks of it, and I'm sort of getting used to it. It's like a look back to
Had a sniff of 420 and then back to weight, didn't it?
Yeah, I mean, that's where we are. We get the clock up, 42 minutes, 41 seconds to this inflation report. It's important. Is it important, John, for the banks? What do you think? I think they care.
I think they care.
I think they care big time.
They responded negatively to the downgrade they had from Moody's earlier this week, Tom. 10 small and medium-sized banks. We moved on pretty quickly.
Big banks. PNC,
from the woes of spring. And
M&T.
we're going to be seeing if some of those issues come back, Tom, make a comeback.
We're going to link in inflation here. We've done a search over the weekend. Bramwell was in charge of the search for the $100 lobster roll. It's out there somewhere, probably up the shores of Maine. Joining us now to brief us on the inflation within $100 lobster rolls is Gerard Cassidy, head of U.S. Bank Equity Strategy, RBC Capital Markets, iconic with New England banking and across from sea to shining sea. Is there a $100 lobster roll out there?
Not yet, Tom. Let's hope not. But, $35 to $50 lobster rolls. But I'll take you to Port Clyde. We'll get them for a lot cheaper than that. I
got 8 ways to go. I'm going to be quick because John and Lisa got lined up a bunch of questions. I was thunderstruck at a credit adjustment for M&T Financial. That's like fighting words for the wonderful Mr. Willens, the late Robert Willens, who made that wonderful, wonderful bank. Were you surprised that M&T was bundled in?
Yes, we were, because M&T is one of the strongest, to your point, when Bob Wilmers ran the bank. The underwriting credit culture there is unsurpassed. But that being said, when you compare them to their peers, they were a notch above their peers in terms of credit ratings, but they should have been because they've got the track record of showing everybody they do not blow up in credit cycles.
Gerard, downgrades at Moody's. Let's talk about them. 3 issues. High funding costs, 1. Number 2, potential regulatory capital weaknesses. And 3, rising risk tied to commercial real estate. Of those 3 points, all well known, what's the number 1 issue we have to focus on?
John, I'm glad you say well known. And that was the surprise with the Moody's news, is that it was kind of late. If they did this back in November or December, you could understand it. But this was all well known, to your point. But if the Fed reaches terminal rate, let's say out in Jackson Hole, that's the last rate increase, the rising deposit issues they have identified go away because deposit costs about 6 months after the terminal rate is reached, stop going up. The capital, if you're a creditor, having the banks carry more capital, that's a positive. But so your third point is the one that we got to watch, which is real estate.
Have things stabilized for the small and medium-sized banks just in terms of what they've got to pay up to attract deposits?
Yes. In fact, every Friday, you might be familiar, they have the H8 data that comes out from the Fed. And if you look at the deposit levels for the smaller banks for the last 8 to 10 weeks, it's been flat. Where the deposit deposits are leaving is the bigger banks because of QT. That's where we're seeing it. So for the smaller banks, they're not having to chase the deposit rates as much as they did right after Silicon Valley.
That said, perhaps it's getting more difficult for them to pay the rates that they need to attract the deposits, considering they've got a lot of competition. You're seeing an increasing number of consumer loan books sold to private equity and private debt companies. You're seeing this sort of shift to be more cautious. Do you think that perhaps some of these downgrades turned up the volume, to use John's language, on some issues that have not gone away, even though the market's forgotten about them?
Lisa, I think you're right. Turned up the volume is a good term, and I think I think you guys are right that it did turn up the volume. But that being said, I would still point out that the credit quality for the industry is remarkably strong. And if you look at the second quarter results, we did see credit losses creep up. They're normalizing. As Jamie Dimon at J.P. Morgan would tell you, his credit card net charge-offs are still below normal and well below pre-pandemic levels. And credit non-performing assets, delinquent loans for the industry in the quarter, or the top 20 banks, I should say, were flat to down. So credit is still strong. So
do you think that the commercial real estate issues are not sufficient to justify some of these moves now?
I would say that in certain cases it is, and that's what M&T, why they were identified. Out of the top 20 banks, they have the largest exposure to commercial real estate at around 24% of total loans, but still manageable. Most of our biggest banks are in the mid-teens, and when it comes to office commercial real estate, that's the CMBS market where the problem. That's private. That's the shadow banking industry, not the big banks.
It's a Thursday in August. We don't do gossip, but it's a Thursday in August, so let's go there. You have decades of experience. How do they transfer leadership at these banks? We've got a James Gorman story today about the churning at Morgan Stanley, all the upset at Goldman Sachs, Montag coming from Bank of America back to his Goldman Sachs, and on and on. The uncertainties of what happens at JP Morgan. How do you monitor that quarter to quarter?
Tom, it's challenging because we don't have very good insights to the inner workings of those executive suites on what the politics are and what the maneuvering is going on. Plus, two of the people you've identified, Morgan Stanley's Gorman and JP Morgan's Dimon, of course, have had incredible success over the last 10 to 12 years. So filling those shoes is going to be very challenging for whoever those people are.
Can you say the same thing about Solomon at Goldman?
He's had a challenge. He's been struggling. So he has not had the success.
It's a New England understatement. The answer.
It's getting tough, isn't it?
Yes, it is, John.
You're seeing partners leave, high-profile people on the research side of things leave. Jeff Curry earlier this week. I don't know what's behind that decision, but it starts to mount. Do you think we're at that point where we're thinking about new leadership?
That discussion has to, again, we don't have inner knowledge of it, but you have to believe at the board level that's probably a discussion point in their meetings. Again, it's just a natural discussion point because of what's been happening.
How badly have they been doing relative to Morgan Stanley? I mean, do you think it's justified, or do you think that it's just noise that's overwhelmed the narrative and overwhelmed the reality?
That's an interesting question because the actual stock performance, though it's lagged Morgan Stanley, people have still made money under Solomon. His valuation, his tangible book value per share growth has been impressive, but it's not as good as Morgan Stanley. Morgan Stanley had the big upgrade in valuation at the beginning of the pandemic that Goldman did not get.
My theme for this year, 2023, the great zombie roll-up. Forget about the zombie banks, but just in general, with the new interest rate structure we have, which is the regional, super regional, where Gerard Cassidy wakes up and goes, you got to be kidding me. This thing's got to be put out of its misery.
Yeah, so far, Tom, we're very fortunate that after what happened in the spring, the wounded soldier that they just took off the battlefield was PacWest in that unique deal.
Hey, who's next? I got to make some money here. I got to buy the lobster roll.
So I think on the downside, it's hard to identify. In all seriousness, it's very hard to identify them. We're a well-capitalized industry with low credit problems because in our old days when you and I were young men,
if we went on mic, you'd have 3 names for me. Can you give? Ferro wants a name. Come on, we need a name.
Well, on the long side, you certainly want to own M&T. I mean, I would certainly be stepping up to that. And then, of course, Brian Moynihan's bank, Bank America, is another one.
You always love BFA.
Yes.
I wanted to build on Bramo's question, actually. Do you sense it's personal when it comes to David Solomon, the coverage of him? I don't know him personally. I've interviewed him when we've spoken. He's been very pleasant. But do you get the sense that it's personal? when it comes to David Solomon and some of the coverage he gets?
I think it could be because his lifestyle was a little different than the other CEOs, as you know, at the outset. So there could be some of that there. I've like you, John. I don't know him very well, but the times I've met him, I've been impressed. He's very engaging. I enjoyed the time talking to him.
John, it's a brilliant question, and the way I would put it, and I would give you a story with Gerard Cassidy here, it's cultural.
Yeah.
One day, Gerard Cassidy and I on St. Patrick's Day, we're with 1,200 people at some Bank of New England or whatever. Yeah. Gerard's is such a rock star. He's within reach where when they're throwing bagels and donut rolls at the stage, Cassidy's getting hit. I'm back in the cheap seats because I'm not Gerard Cassidy. But it was cultural about the Irish banks coming over and buying in. And this is Brian Moynihan way back, Bank of Boston or even Fleet Bank before that. And that it's hugely cultural within the business. That's underplayed by the media.
John,
you're right.
Good to see you.
John, Lisa, Tom, thank you very much.
Thanks for being in with us. Gerard Cassidy of
lobster
RBC
next time,
Capital Markets. Can't believe how much that lobster roll costs.
There's one that's $160.
What's ridiculous?
$160?
Yeah.
But what's ridiculous, John, is the line is 6 blocks long.
$160?
Yeah, I'll share this with you.
How many lobsters are in
Taste
it?
of Maine. I don't know, 45.
Taste of Maine's
Mainly
expensive.
We think there's going to be some choppiness here. We think we're going to see a pullback in the fourth quarter of this year.
You tend to have 3 to 4, 5% pullbacks in a given year. We've had one this year. So I think it's time to have one.
I think the second half of the year, inflation ticks higher. I think we finished the year probably closer to 4% on headline CPI.
We are in a disinflationary trend.
The challenge will be if the Fed does indeed remain higher for longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A busy day, a countdown clock here at the 8 o'clock hour, 29 minutes, 18, 17, 16. To a statement on inflation in America. And John, it's a complex story.
We want further signs of disinflation, Tom. We'll be looking month over month for that, expecting that to come in at something like 0.2, in line with the previous month over month reading, and setting us up potentially for a pause at the Federal Reserve on September 20th. Even those out there who believe inflation might reaccelerate in the back half of the year, they don't think the incoming information between now and the next Fed meeting will challenge that soft landing narrative. City's Veronica Clark has written about that coming into this print, Tom. That seems to be the view, that the data between now and then is going to show the same as it's shown over the last month or so.
It's a granularity of inflation as well. I go to the big ticket items like rent. We mentioned New York City rent earlier. John, a car dynamic as well, the food dynamic as well. But within all the granularity, there's the way the public feels, and it's separate from the Bloomberg surveillance audience.
Are American companies losing pricing power? That's a conversation we can have
That's
post-earnings.
the investment question.
JetBlue, Southwest, talking about maybe flagging demand, maybe cutting airfares. We'll talk about Capri a little bit later in their deal with Tapestry potentially. And then Tom, Disney. Subs were light at Disney and they're putting prices up. Let's see how that goes. Is that tolerance there in the American economy the same way it was maybe a year or so ago?
I think you nailed it. I mean, Margie Patel and Jessica Reif Ehrlich make it very clear they don't see a problem. Lisa, I don't buy it for a minute. I think this inflation report that we're going to get in 27 minutes, 51 seconds, this inflation report is simply a statement on what American corporations can do. And there's this belief they can raise prices. I'm not sure I'm there.
I think the issue with Disney is if people are using it to babysit their kids, then they can take a 27% increase in costs, and it's probably a very cheap babysitter. But if you don't and you have it as a peripheral service, it's different. I'm just saying, theoretically. I am wondering where the bias is in markets. If we get an upside surprise, how disruptive that could be to market positioning that is preparing for a soft landing, signs of disinflation, et cetera, et cetera. In other words, how much do we end up getting a big surprise in markets, downside surprise in terms of price action, if we get signs that disinflation isn't happening quite as quickly?
I'm going to fold disinflation report into the guess on nominal GDP and the guess on revenues. And John, you see it right now with Ralph. All you got to do is say Ralph. It's not like Tapestry. What's Tapestry? We don't know. Ralph, we know. Revenue flat, up slightly, constant currency. That's that revenue struggle.
Stock is down by 1.5% in the pre-market. You've mentioned that deal twice now, so let's discuss it, Tom. I believe it's an $8.5 billion deal. Tapestry going after Capri. Capri Holdings is up by 57% in the pre-market, Tom. Tapestry's down 4.7%. So what is this? Kate Spade and Coach going after Michael Kors?
Yeah, or so. I mean, Critty wrote me a note. She's a lot smarter on this than I am. And the bottom line is, it's Tapestry buying Michael Kors, but really it's a roll-up into Michael Kors. It's sort of like the inside baseball question. I'm not informed on that, but...
You sound well informed.
I've
on
never
this
been
deal
in a
all morning.
Tapestry store. I've never been in a Michael Kors store.
There's no Tapestry store. It's a parent company, and you're humming Carole King and her Tapestry, which is fantastic.
Have you been to Coach before? You never been? Kate Spade?
I have been in Coach because of Tom Wesselman, They did a whole
Stuart
line
Weitzman.
of stuff with the great iconic artist Tom Wesselman, and I had to go in for that.
Weissman do those thigh-high boots, TK. Familiar?
No, I'm not.
Equity futures.
Moving on to the data check that will save us.
Stocks positive
Are
by
you
0.5%.
You're like an HR violation. You're like a rolling HR risk with me.
I'm talking about product and branding. Come on.
Come on. You mean
Yields are
James
lower
Chu?
By a couple of basis points. No, the Jimmys. Yeah, Jimmy Choo's. Yeah,
They,
sure.
they have those boots? I don't think
Jimmy
so.
Choo, you always see on sale. You always see Jimmy Choo on sale. Always.
Do you?
You know that rack at Bergdorf's? The sale rack that you get dragged into? Sale.
You mean second
Sale.
floor, aisle 3?
Up the skinny escalator. No, well, yields are lower by a couple of basis
Group
points.
therapy.
On a 10-year, it's needed. Tom,
John and
the
I go
10-year,
shopping there all the time.
398.58 on a 10-year.
We're going to continue here, and seriously, 25 minutes away from an important inflation report. And it is wonderful and honored to have Peter Shear with us, head of macro strategy at Academy Securities. They take a geopolitics view and fold it into the investment view forward. This inflation report, how does it affect our investments in general?
I think it's going to be a relatively minor influence on markets in the short term. I think right now the Fed is waiting for a lot of data to come in. They're looking at inflation. They're going to look at jobs. I think they've really changed their outlook, right? 6 months ago, they were still looking for any excuse to hike. Now I think they're being a little bit more cautious. So I think every little bit of data, the market reaction is going to be muted. I think we've set ourselves up to fade on a little spike in inflation. And then I think people buy that dip.
To Lisa's point, what kind of upside surprise do you need on CPI to reintroduce the risk that this Fed might go again in September?
I think you need to see something shocking, gets you back above 4% or something. And again, I think the media, the narrative about the public doesn't care as much about 3% or 4% inflation. 5, 6, 7, 8%. Yeah, you can get a lot of momentum and people can talk about it. But I think, at this level, I think it's kind of status quo for the Fed.
Do you think that it matters that there has been an increase in the longer term inflation pricing in markets as we get the sense, as the Fed gets comfortable with the idea of staying on hold?
Yeah, and I think that makes sense. So our longer term outlook has really been that we're going to be in this 3 to 5% inflation environment for the next 3 to 5 years. And a lot of that, whether you want to call it geopolitical inflation, onshoring inflation, it's part of how American companies are going to do business, right? They are going to change where they're producing, how they're producing, what sources of their supply chains look like. The government's doing that. So I think that's going to keep inflation above that 2% for a period of time. But I think we can live in that 3 to 5%, especially if it really is around this kind of security of your supply chain.
Is that what we've been feeling over the past couple of weeks? That essentially markets are getting comfortable with the idea that the Fed is going to let inflation sit around 2.5% to 3% for a long period of time, that could be okay, benign for a lot of the companies that are reporting earnings, and bond markets are already priced there. Is that basically what we're seeing the new narrative is developing?
Yeah, I think that's the narrative that's developing, and I think the new one beyond that's going to be, what does China do to combat this, right? Everyone was talking earlier this year about the China reopening trade. I think clearly that's a misery, right? It's just not happening. I never thought it was really going to happen. But China is no longer going to be this big factory for the U.S., so that's changed in China. The Chinese consumer is not the American consumer, and that's especially true with the problems that are going in real estate. So our view is that China, and this is, I think, something that's not yet being priced in, is as we're doing this reshoring, as we're figuring this out, I think the next stage in this kind of friction with China is China aggressively trying to sell their brands globally. And I think they're going to go after the emerging markets countries. And that's something we're not seeing. We've never really seen China as a competitor selling their brands, except for Huawei. And they had phenomenal success with Huawei. Look for that push to occur in other things, whether it's their EV makers and stuff. And I think that's going to be the narrative for the next 2-3 years, that U.S. companies are going to have to deal with competition from Chinese brands.
I got to rip up the script then because of the overlay of your shop. You have an exceptional at Academy of Securities. You have an amazing overlay of military. We've got in the Black Sea new naval affairs with drones, They're frightening whatever side anybody's on. Bring it right over to the South China Sea, where Marcos is going after China now with the ship floating around the south. It's like out of a Stavridis novel right now. Overlay the geopolitical uncertainty around your belief in China and how American investors should respond.
So I think there's going to be ongoing friction with China. I think Chinese companies may do well selling some of their products, particularly in emerging markets. I would not touch Chinese stocks because of this friction. And probably 2 years ago, I think we were relatively early in talking to companies about when they were thinking about reshoring or onshoring or moving out of China. We talked about not going into Southeast Asia. And that was, I think, the natural reaction before the Russian invasion. I think people have become wise to that. They're sitting there and seeing the Chinese Navy expand, right? They went from what we call this brown water Navy, which is coastal, to blue water Navy, so they can project their power. We kept telling them not to build South Island Sea, and they kept building up those islands, right? They struck a deal with the Solomon Islands. Solomon Islands has now, since then, stopped at least one U.S. Coast Guard ship and a U.K. naval vessel from boarding in Solomon Islands. So you see this projection of power, and I think we're really going to have to see the U.S. has to concentrate on North and South America, develop better and stronger relationships with South America in particular, where we have the geographic proximity to them. China has some inroads, and we're going to have to figure out what to do with Africa. It's such a burgeoning economy, and we just wrote about this. One of our journalists pointed out the other day when there was a coup in Niger, people didn't realize the people in the protesting were shouting, "Long live Putin," right? So Russia does have power in Africa. So that's where we're going to have to concentrate our global focus, South America and Africa.
Can we just finish on the weakness within China right now? 10 years ago, if you came up with a bearish thesis around China, it sounded something like this. Local government debt was piling up. It was piling up because they were trying to hit growth targets and please central Beijing. And what you were seeing was a property market bubble forming. And ultimately, people would say, in the end, they're going to have to deleverage. Property prices are going down, developers will go bust, and this economy will sink. What are we seeing develop now? We're seeing property developers go down, local government struggling to stimulate the economy to get GDP to where China would like it to be, and property prices are starting to come with it. And yet we're just shrugging our shoulders. Isn't this the ultimate bearish thesis that was laid out a decade ago, playing out before our eyes?
Yeah, I think it is. And I think that's why China's reaction is going to have to be, how do they sell their goods, the things that they're making, probably with stolen IP, into the rest of the world, right? If you can't figure out what you're doing internally, look at that projection of power. And don't forget, they've set up all these Belt and Road initiatives. They have access to ports. They have big deficits to a lot of the autocratic resource-rich nations. So that's the places they're going to start trying to sell their goods, right? If you've got this internal problem that they've been working on for 2 or 3 years that's failing, well, you can either keep trying to fix what's not fixable, or you expand. And that's why I think they're going to be aggressive players on the global scene. And if you think about it, think about what China does even politically outside of the country. 2-3 years ago, you never really heard them doing much. They're getting involved with Saudi. They're helping Saudi strike a deal with Iran. They're the only ones really talking to both Russia and Ukraine. So I think that's going to be the shift in how China tries to deal with this. And we're all sitting there, oh, you're collapsing, this sucks internally. Well, guess what? They're not going to take this line down, I don't believe, and that's going to be their push.
And they haven't. Pete, thank you. Peter Chair of Academy Securities, really thoughtful stuff. Seeing China at the epicenter of foreign policy issues has been pretty remarkable, incredible, Lisa, over the last year or so.
It speaks for the desire for some sort of global influence, and it raises a question of what that does to some of the U.S. companies globally if they have to compete.
We've always given the policymaker in China the benefit of doubt, and I think we continue to give them the benefit of doubt currently, and we'll see how it develops. If you are just tuning in, welcome to the programme. The S&P 500 positive here by 0.5%. As we count you down to the CPI report, 17 minutes away, the bond market rallying just a touch here. Yields are lower by 3 basis points. We'll bring you that report and then bring Neil Dutter of Renmac to you, Tom. That conversation coming up a little bit later.
Really curious about his durability of a 4% statistic right now from Atlanta GDP. Michael McKee was brilliant yesterday, John, on how that's just a current number and it will amend as we go through the quarter. But I wonder if Dutta's pathway is from 4.1% down to 3.x% or down to 2.x%. He's the optimist out there. It'll be interesting to see.
He's pointed to housing so many times. Housing's still doing all right, Lisa, in certain parts, bouncing back. We've talked about rentals. Are we starting to see the limits of our tolerance for higher prices in this country, particularly here in New York City, as volumes start to drop, even though prices are still climbing?
You know, this has been the issue, but it's been an inventory issue. I mean, that's been the problem, is that just aren't the homes. And if you start building them, maybe. Can I just say, that this has got to be the least important CPI report ever, based on how people are talking about it, that it basically doesn't matter. Am I wrong?
That's why my radar's up.
That's based on what they expect.
Correct.
Because they expect further signs of disinflation, and there's extreme comfort that will continue through summer. We'll find out in 20 minutes if that's misplaced or not.
Extreme comfort. I think that's
an uncomfortable calm.
I didn't know who Carrie Bradshaw
comfort.
was.
Hey?
Twitter's informing me who Carrie Bradshaw was.
Oh, yeah.
I did not know.
I've had a lot of feedback about that. Charlotte York was where it's at. That's official, right? And it doesn't matter, all right? From New York, this is Bloomberg.
I'm just saying.
Disney's a great example, as they felt they had room to raise prices, and I think they'll be successful in retaining those price increases. And that's one of the reasons why we've seen corporate margins really maintain themselves. A lot of people thought this year we'd see margins really get squeezed, but companies have been able to pass on price increases.
Marky Patel there, Senior Portfolio Manager at Allspring Global Investments, going into the CPI report, which is 13 minutes away, looking for further signs of disinflation in the American economy. The price action shaping up as follows. Going into all of that, we look like this in the equity market. Positive here by 0.6% on the S&P 500. In the bond market, yields a little bit lower by 2 or 3 basis points. Big focus on the earnings, as always. Yesterday, after the close, we had earnings from Disney, Tom, the Walt Disney Company. The earnings better than expected. The revenue not so much. Cost cutting
there
is where it's at, partly due to the strikes, and I think that's gifting the stock a rally of 1.4%. But going forward from here, prices are going up for streaming, and subs were disappointing.
I defer to Paul Sweeney, Jessica Reif-Ehrlich, Michael Nathanson, Rich Greenfield, everybody else on this. They can tell me all the ratios they want. It doesn't matter. It's a busted business plan, and Mr. Iger knows that, and he's got to fix it.
How's he going to fix it?
Well, I thought Jessica was very good about that there's a huge mystery. He's bringing in some ex-guys to consult in and all that, but it's not the same business. You sit there at a restaurant in L.A. and go, which movie are we going to do next? Is that the formula? I think so.
Which Marvel movie comes next?
Well, yeah, I don't have any wisdom on that. You know, they didn't do Barbie. I know that.
Well, things are getting sold. I think we know that. It's just what's getting sold.
To who?
Lisa, that we need to figure
price?
out. Well, precisely.
That's been the issue. But at the same time, if you are better, bigger, that is sort of the theme. Are we seeing that it is better to be bigger? And if so, maybe Apple gets a little bigger. Maybe one of the other streaming networks gets a little bigger. But it's not Disney because they don't have the critical mass.
We're going to slip this in right now before we go to inflation here. Michael McKee is on standby. He's in New York, and we'll go beneath the headline data here at 8:30, about 11 minutes away. But we really wanted to talk about this iconic blue chip stock of another time and place that's become a single-digit marvel. Geetha Ranganathan is expert on Disney, on media. She is with and owns Bloomberg Intelligence. Geetha, I was thunderstruck by the McKinsey-like discussion yesterday. Are they talking security analysis, or are they going into consultants to blow up the company?
I don't know. It's a little bit of both, Tom. So, we obviously had Bob Iger on the call saying that still all options are on the table when it comes to the beleaguered TV assets. So you have, this wonderful portfolio of assets, some of them doing extremely well, like the Parks business, which will bring in about 75% of profits this year. But on the other side of the equation, you have TV, which is, obviously in secular decline. He has, as you mentioned, brought in Tom Staggs, Kevin Mayer to kind of look at how to go forward with that. And then you have kind of ESPN there stuck a little bit in the middle. I don't think they necessarily want to get rid of that. We already saw them do that Penn National deal. And I think it makes sense for them to kind of keep ESPN as part of that broader streaming portfolio as well. And then you have the streaming business, which is kind of very much in transition. So it's...
John, the heart of this is Craig Moffett, Michael Nathanson's colleague.
Sure.
He was years out front on cable cutting. That's what this is about, is people are watching less, period.
What have we ended up with, Tom? Tons of different apps. Tons of different apps.
What's your total per month? I bet you know
just
the
ridiculous.
Penny. I've never had
not
mine
to the
up.
penny, but it's a lot now. It's a lot. And Geetha, it's going to be a lot more. So the ad-free version of Disney Plus is going to cost $14 a month in October, from $11 currently. How many people do you imagine are going to cancel their subscription based on that move?
Disney is betting that not many people are going to cancel at all. So that they already did a price increase just at the end of last year. They said that the results of that were actually very, very encouraging to them. And remember, John, I mean, the whole streaming narrative has really changed. Initially, when all of these companies made that pivot, it was really a volume story. Now it's a pricing story, right? It's all about ARPU growth. It's all about increasing that top line. We're seeing kind of Netflix do that. We saw Paramount Plus kind of raising their prices. Now Disney is doing it. And if you just kind of look at Disney versus Netflix, I would argue that Disney was substantially under earning, right? When they introduced their ad-free product, it was $7 a month. Now, of course, they're making it up close to almost $14, which is on par with Netflix, with $15.50 for an ad-free version. So they were under earning. So it's time that they kind of narrowed the gap.
Would you be happy if they sold their streaming business to Apple?
I don't know if that would even pass regulatory muster. And again, I think the streaming business makes sense. They have all of the content engines. Obviously the studios. It kind of depends how they divvy up the assets. Yes, if they sold the studios and the streaming business together, that might make sense. But then again, who would want to buy the parks? It's going to be very interesting to see how exactly, if at all, a deal goes through, how those assets kind of even get divvied up.
Geetha, thank you. Geetha Raghunathan there of Bloomberg Intelligence. On the Walt Disney earnings, Tom, you're frustrated by this
I've
conversation.
never bought it from day one. I have the clearest memory of being in Hollywood, I'll say 3 or 4 years ago, and you drive down the street. We got the Bentley. We're going down the street, and they got up on the light post. They got the Paramount. They're selling Paramount streaming, Paramount this, Paramount that.
Yeah.
Their market share is like 2% or whatever it is. Maybe it's 4%. But Disney's like 8% market share of streaming. Netflix is killing them. This is not rational. This is not the way adults talk. But then it's Hollywood.
How do adults talk?
They talk about market share scale. What are we going to do to affect a transaction? Who's on the other side of the ESPN transaction? John Sky?
So you're saying they don't talk about, Cinderella and Mickey Mouse? Is that what you're saying?
No, what they're talking about right now is what do we do after
Disney.
Barbie? I'm sure that's all they're talking about.
It seems like there is a bigger discussion around which parts of our business are the most important and are core to everything that we do. And in the past, it was a broader suite of core businesses, and now it is the parks. We hear sole emphasis on the parks. So there is a question about what isn't core and what they're going to do to rationalize or get the kind of critical mass that is relevant.
John, I like what Zero said yesterday about the parks. You got to give away your left kidney to go to them.
It's so expensive now. It's ridiculous. When
Let's
people break down the cost of that to me, I'm like, why? Why would you do that?
We went once when I was a kid, when I was about 5, because we got free tickets.
Okay,
ESPN needs English football. That's what they need. It's like a weekly show, Tom. You could do that.
A weekly show
Saturday
on the weekends.
mornings, Saturday mornings.
Some talk show.
ESPN before the games. That'd be great.
The English Premier Formula One show would be great. John, they just ruined my ear. The countdown clock, just 7 minutes. Go to McKee.
Is it 7 minutes? I was going to go to Mike anyway.
Go to McKee on the
That's a tradition. Yeah, Mike McKee. How many minutes until the CPI report comes out?
Well, it looks like 7 minutes, John.
There we go. What are you looking for,
I
Mike?
heard that somewhere.
Crushing it.
I'm looking forward to streaming surveillance and Tom Keene and Roy Keene from...
Yes.
Wouldn't that be a great pairing?
Tom has no idea who his cousin is.
I just want to hold the mic. John, what is it about the mic that they put up like this? That's the British mic?
It's a lip mic.
Oh, yeah.
It gets rid of the background noise. Yeah, I've used those when you're in a very crowded
When you're in a stadium,
situation.
Tom.
Yeah.
All I had was the little pastry thing that you didn't tell me.
You had
how
a
to
pie.
eat.
Yeah.
A pie.
And you ate it with a knife and
They
fork.
were all taking photos of me because I look like
the American
a
understand
tourist
eating
over
a
there.
pie with a knife and fork.
What do we got here, Mike? 5 minutes, 50
well,
seconds
we've
away.
got, in theory, an indication that inflation continues to slow. That's the bet. Headline inflation pop up a little bit because of energy prices and base effects, but the core is expected to drop, and the month-over-month increases are supposed to be still small. Any difference would probably send the markets into a tizzy, especially if it were higher. There is a lot of talk these days about, have we gotten as far as we can go for right now with the Fed not doing more, and are we going to see the economy reaccelerate and inflation reaccelerate? And you see that a little bit in the inflation futures.
So today, do I ignore year over year? Do I ignore that?
I would ignore that, yes. Look at the month over month. But the other thing is, as I described CPI yesterday, this is the least consequential, most important report that we have this month, because it's important and the markets will trade on it and everybody will talk about it, but we have 2 more inflation reports before the Fed meets again, so this one won't change their mind.
Did he just say this is a snooze fest?
No, it's not a snooze fest. It's still gonna have information content.
No, do you know why it's not? Because it's Mike's birthday, and this is how he likes to celebrate his birthday, is with CPI reports.
Yes.
And it's to make sure that, especially if people are buying him gifts, he knows just how much more we're all paying.
That's true.
Do you like Stuart Wiseman?
Yeah.
Just checking.
What about Michael Kors?
There's some stuff that's okay. Yeah,
Coach, okay, all right. We'll figure something out for you. Right. Mike, happy birthday.
Thank you.
You got Mike a gift, Tom?
I don't know. I don't.
That's a no.
He gets a fruit basket from the Fed. No, the Fed sends him a fruit basket.
Oh, right, really?
Yeah, they do.
Maybe just the first question.
Okay. The inflation report in America just seconds away. The scores going into it on the S&P 500. Equity futures rallying all morning, up 0.5%. In the bond market, treasuries rallying all morning. Yields are lower by about 4%, 4 basis points going into this one, to about 4% on a 10-year at 394.17. With the inflation report around the table with us here in New York, here's Mike McKee. Morning, Mike.
Good morning, John. Well, the numbers are in, and the numbers kind of match what was expected. You guys out there forecasting this hit it on the head. CPI 0.2 gain for the month, and CPI core 0.2 gain for the month, with pushes up the headline year-over-year figure to 3.2% and drops the core year-over-year to 4.7% from 4.8%. So, as the bond traders would say, this one was on the screws, came in right as forecast. Initial jobless claims, let's not forget that. This one jumps. We're up to 248,000. The prior week was 227 on an unrevised basis. We'll get the revision in just a second. Those are dropping slowly. But the continuing claims number, 1,684,000, that's down from 1,692. So a little mixed news on the jobless front, and it could be some strike activity in the initial jobless claims, but we don't know for sure. We'll have to look into that. But claims are not the good news. For you at home, you're still getting ahead of inflation. Real average hourly earnings come in up 1.1%. That's a little bit slower than the 1.3% in June, but it still means you're making more than inflation's going up.
The initial reaction, Mike McKee, thank you very much. The equity market up by 0.8% on the S&P 500. In the bond market, that rally extended to the front end. Yields lower there on a 2-year by 7 basis points to 4.73. In the FX market, further extra dollar weakness. The euro breaking out now by 0.75% against the US dollar on the session. That currency pair positive by almost 0.8% now. Tom, 110.60 on the euro. So in line for CPI, month over month. Further signs of disinflationary forces taking hold.
Yeah.
Equity market up, bonds rallying, dollar weaker.
I mean, I thought Mike was dead on there on the screws, as he says. And the answer is, I look at inflation-adjusted weekly earnings, and it is a quiescent number off of a revised 0.7% inflation-adjusted a weekly increase down to 0.2%, positive 0.2. So that's a kind of disinflationary tone, and that makes everybody, including the stock market, feel good. Maybe the Teamsters will not make 170,000; they'll make 167,000.
Mike McKee, have you got that Supercore print? Have you got a read on that just yet?
I don't have the Supercore just yet, but I can tell you that rent of shelter and rent of primary residence and OER, all those numbers come in at 0.4. So that is about the same in line as it was the prior month. So no great drop in overall numbers. But the owner's equivalent rent comes in up 0.1% at 0.5. So that's not going to be seen.
I'm looking over at Mike here with 7 pages of printout here. It's totally impossible. First of all, I can't see it. Your eyes are better than mine. But my answer is we got a 1.1% move in NASDAQ 100. Obviously, the market likes what it sees. What do you see in that blur of data that tells you they like what they see?
Well, what you're seeing here is basically in most categories, just a small increase in inflation. We're seeing a definite slowing down overall. Food prices up 0.2, food at home up 0.3, which is a bigger gain than the flat number last month, but it is still not huge. Energy prices contained, even though we saw gasoline going up at the end of the month, it was only up by 0.2. And then you look at used cars down 1.3%, new cars down 0.1%. So we're seeing, and apparel flat, we're seeing basically inflation that is relatively tame. I mean, these are the kind of numbers we used to get prior to the pandemic, before we had the big inflation run up. So this isn't too bad.
Kind of like what we saw in the payrolls report, Mike. It's like a pre-pandemic report in some ways.
It is. And the weird thing is we don't know if this is a pre-pandemic report or if this is just the way things are these days.
Well, that's the question.
That's the hard part to know.
Does this change after the summer? Have we got the ingredients here for a re-acceleration in inflation?
Well, that's the argument.
The
macroscope column Simon White wrote this morning on Bloomberg suggests that this is the best, and now we're going to see inflation go back up again, and the market's going to be caught wrong-footed. I know Neil Dutta is going to come on and tell us that we're all crazy to think that, but
Jim
but
Bianco,
there is an
Bianco Research
argument.
has made that point. Yeah,
there is an argument out there on that.
Let's turn back to the equity market. So equity futures initial spike. It fades. We're positive by 0.6%, which is basically where we were going into the number. Looking at the bond market, yields were lower on a 10-year going into that by about 4 basis points. Now lower by a couple of basis points to 3.98. We're down 6 at the front end on a 2-year. Let's call that 4.75. Dollar still weaker against the euro. That fades a little bit as well. The euro, that move on that currency pair, 0.6%. Coming up in the next hour on Bloomberg TV, Jean Bavin of BlackRock. He knows something about central banking. Robert Tip of PGIM Fixed Income knows a little something about the bond market. And Sarah Malika-Nuveen knows a whole lot about the equity market, Tom. All of that still to come.
Interesting to see Brent crude 87.37 off this. I'm going to call it a churn for oil, but nevertheless pushing against the disinflationary tendencies outside of core CPI is what we're seeing in a gallon of gas. Neil Dutta is an optimist. He's head of U.S. economic research at Renaissance Macro Research. He's absolutely nailed the better than good American economy. Neil, I got to go to GDP first, and then Lisa and I want to dive into this inflation report. And the basic idea, Neil, is Atlanta GDP sees a sprightly initial start to the quarter. Are you at a 3% run rate on a real GDP, or are you at a lesser run rate?
Well, I mean, remember, it's still very early in the quarter, and the Atlanta Fed tends to get, that estimate tends to get better over time as more data comes in. But even if you assume, a typical kind of, error term, and like, let's say it's all going down, you'd still be talking about above trend growth. So it'd be really hard for me to see, GDP coming in something below, 2.5%. when the quarter's all said and done. There's just a lot of momentum behind the economy, right? So when you hold things like the level of consumer spending flat to where it was in June, you're still talking about a build-in for the third quarter from consumption of over 1% at an annual rate. So I think that's primarily what's driving the GDP Now estimate. But look, I mean, the economy is growing above trend. Your own Bloomberg consensus sees GDP, I think, barely 0.5% in the third quarter, negative in the fourth quarter. I think that is highly unlikely, and that revisions will, be skewed to the upside.
So right now what we're seeing is a broad sigh of relief in markets with some cheering in the bonds, where you're seeing basically people writing off the Fed, raising rates again, and saying you are seeing the soft landing. You are seeing the disinflation, you can call it immaculate or whatever else, that a lot of people were waiting for. What in this data can you point to say they're wrong?
Well, it's not much. You could make the argument, I think, that the downward movement in used cars will probably only build over the rest of the summer. We do know that wholesale auction prices continue to come down. And thus far, we've only seen a very modest decline in used car prices. So there may be some more pass through there. So I do think that there's probably a little bit more disinflation in the pipeline. But again, I think the reacceleration story for inflation, it's really about, in my view, is the economy growing above trend or not? And I think the economy is growing above trend. I don't think the Fed has done enough. And I think the Fed is kind of enamored with this soft landing view. They're almost wish casting this outlook. And I do think that there is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up, sometime next year. We do know that home prices are rising. While the relationship between home prices and rents is very tenuous in the short run, I mean, ultimately, the asset market effect is what drives rents. I mean, landlords don't charge, they want to extract more from tenants when the underlying value of the asset that they're putting on the market is going up in price. And commodity prices, look, I mean, oil is at year-to-date highs, more or less, with everyone concerned about China and Europe. I suspect these economies probably won't get much worse than they are now. I mean, that would be my baseline expectation. And there's probably, in other words, there's more room for oil to go up. And that's going to have very mechanical impacts on not just headline inflation, but parts of core inflation as well.
I've been looking at the pricing in markets of Fed policy and where people are settling out. And they're now pricing in cuts at the first couple of months of next year. And I'm wondering, from your vantage point, Neil, how disruptive it would be if suddenly that market complacency is challenged by the idea of stickier inflation, reaccelerating inflation that wouldn't even cause another Fed rate hike, but just wouldn't necessarily lead to those cuts.
Yeah, I mean, it depends, right? Because if it's a stronger economy and stronger growth expectations that's making the market price out those cuts, I mean, that could be in an environment where equity markets could potentially work, right? So you see higher interest rates and that hurts, but you'd expect earnings and expected earnings expectations to go up, so that could be okay. But I do think, to me, it comes down to something very, very basic, right? The Fed began hiking in March of last year. And since then, what do they have to show for it, really? Powell talked about pain being necessary or likely. We've seen the unemployment rate actually tick down since then. GDP is growing above trend. Broader financial market conditions are as easy now as they were then, maybe if not easier. All deference to the Fed's new financial conditions framework. That number, when it was published, showed financial markets being a headwind. Now that right. has basically gone to zero. So what have they actually done? So I think it comes down to something very basic. Either you think the labor markets are a conduit for inflation, or you don't. And I think what we're seeing now is basically tight labor markets, a lift to real wages and I think ultimately people will go out and spend more money, booming household demand, and I think that'll keep prices in the aggregate stickier for longer.
In the aggregate, Neil Dutta, thank you so much with Renaissance Macro here this morning. I think the heart of the matter is in the aggregate, in that maybe, Lisa, there's two Americas. There's one that is prospering. They're going to Disney World. They're giving their left kidney to go to Disney World and all that. And there's another that's flat on their back. And Neil has been brilliant about parsing that into the aggregate.
And there's also where you put the priority in terms of what you're going to spring for. What are you going to spend on? And you see that, too, people kind of being a lot more discretionary about where they splurge. You're
turning the bond market right now. Standard & Poor's 500 lifts a little bit, up 0.3%. Right now, Michael McKee with us here doing the math. He doesn't have like an HP 12C, on his calculator. He's got an old Cray supercomputer under the desk to figure out what's the thing you sum together here. Service sector, Jerome Powell's
core services ex housing.
Core services
is the Powell indicator, and it's generally
is summer camp services?
There are different definitions of supercore, but
is inflation in summer camps of services?
Yes.
I'd have to look at summer. Well, let's see if it's in here. I can tell you that as far as Disney World goes, that admissions to recreational places up 1.3%. That's one of the higher things. So you were right, Lisa. You called that in terms of park admissions.
What do you see seriously in the service?
The Supercore number comes in at basically 0.19. So you're looking at just under 0.2% for the month, which is up from flat the prior month. And on a year-over-year basis, we're looking at 4.2%. 0.5%. So that goes up a tick as well. I don't think that's going to worry the Fed all that much, but it is not going necessarily in the right direction. So we'll keep an eye on that going forward. Airline fares, though, you bought your ticket to Jackson Hole, right?
Yeah.
Because they're down 8.1%.
Yeah, where?
So
precisely. There's the PhD question.
I'm sorry,
Where?
but and then besides, it's down from what, right? People are saying, "What are you kidding?"
That's the
because
problem.
the year-over-year cost is still so high.
Yeah, everybody looks at what they're paying at the checkout stand, and it's they don't notice.
Yeah, they don't notice the decline.
Bacon was down 0.7.
Yeah.
Did I notice that?
Exactly.
Michael McKee, thank you so much as always. Leading coverage worldwide. Michael McKee. This is Bloomberg. Good morning.
We have a post-CPI clock, which is now 16 minutes past the CPI print, and nothing has changed. This is Bloomberg Surveillance. Tom Keene and Lisa Abramowicz, John Ferro off preparing for the 9 hour. And I do feel like this was not particularly exciting for markets. That's my sense.
I think if you dive into the data, there's going to be some excitement there. There always is in hundreds of data points, almost like a David Rosenberg analysis. I really don't care if it's up, down, vector, whatever it is. To me, and you've mentioned this a couple times this week, Lisa, it's the x-axis. It's the how longedness of whatever the policy outcome is. I think people have to learn that there's not going to be drama, and they're going to stretch it out to this Jackson Hole, maybe the next Jackson Hole, or Jackson Hole 2025.
For now, it definitely is cheering a bit of good news in the markets. You could see bond yields down, bond price up. You could see stocks up marginally. Take a look at the 2-year yield, 4.77%. That's after climbing as high as 4.8%. The 10-year now below 4%, but not a lot of drama, just kind of meandering around the same place. You see the S&P up about 0.4%. We have been talking about a couple of stocks, a couple of stories in this era of more inflation, but still strong consumer spending. We keep coming back to the luxury or almost luxury or whatever you want to call it, the retail sector and consolidation, and whether size matters so much more now that it is important to pay a premium. Tapestry shares down 6.3% after saying that they are going to buy Capri Holdings, the owner of Michael Kors, as well as Versace and others, for $8.5 billion. You could see Capri shares up by 57%.
Yeah.
I think this is an interesting deal because it shows the need to consolidate the need for size.
Scale, the great zombie roll-up. These are not zombies. These are legitimate firms. They're not trash. But the stock performance are really of both Tapestry, I'm going to call it mediocre as a general statement, and Capri is actually worse than that. The answer is it is that mid-luxury roll-up. Bloomberg Intelligence will have some terrific work on this in the next 12 hours or so. What I would really focus on, Lisa, is I'd focus on Madison Avenue, and it gives you some scale through real estate negotiation worldwide.
That's a great point. I also just want to quickly mention, because we are about 40 minutes away from the opening bell, very curious to see whether this gain in Disney is going to hold, Tom, given the concern about the longer-term trajectory of growth. And I'm watching Novo Nordisk. At what point do people start to say, okay, if they can't make it quickly enough, that's going to be a boom?
We got a great viewer that says he's lost 51 pounds or whatever with his stuff. He was
but grown an extra arm?
Yeah, whatever. But he's, I guess it works, but you just can't. There's got to be a free lunch factor in here. Have you discovered what it is? You've done better work on this than I have.
It's still breakfast time for some people. So I think
it's a shot.
Yeah, well, that's Ozempic. I mean, basically, there are some, nausea and other types of physical issues that kind of come along as potential side effects. Anyway, we will investigate. We'll do a deep dive into the potential ramifications.
Let's pick someone that could probably use this stuff. I'm going to mention Euro Yen 158.70. I'm watching it like a hawk, a 160, 160. Strong Euro weak yen would be something to see overnight in Japan. We get clarity now on an August Thursday with David Kelly, Chief Global Strategist, JP Morgan Asset Management. He has been definitive over the decades of the holistic picture. David, I do want to get to your stunning call on jobs, but let's leave that aside right now. Do we have disinflation in America?
Yes, we've sort of got gathering disinflation in America. We've got the numbers this morning were close to what we thought, but it's nice to see the sort of the core services part of inflation coming down. But what I think I'm most interested in is it's not actually the numbers, it's forecasting the numbers. Because when you're trying to forecast these numbers, you realize, okay, new car prices have basically been flat or down since the start of the year. And we're still seeing these huge increases in auto insurance and auto repair costs, but that's got to break. And same thing with shelter costs. Shelter is about 90% of the increase in CPI at this stage, but we know that rents have stopped rising. We know that there's a rising vacancy rate for apartments. So what we can see is the promise of future disinflation in these numbers, and really trying to forecast these numbers. And that's why I'm so convinced that inflation is going to get down to 2% on its own, with or without any help from the Fed.
In your summed statement, and you and I have talked about this over many years, including with Bob Goodman years ago, there's an underestimation of the x-axis. Are we underplaying in our what's going to happen next quarter, what's going to happen in Jackson Hole, what's going to happen to the meeting? Do we need to extend out our study a year out, or dare I say 2 years out, to get to a successful disinflation?
Well, for investing, you always should, because equity investing, and most of your viewers are interested in the stock market. It shouldn't be about the next year anyway. But yes, I think particularly this time around, I think that's the case, because what we know with inflation is it's very symmetric. It actually looks like the Eiffel Tower. It goes up and comes down in exactly that pattern. We saw it in the 1970s. We're seeing it again now, 40 years later. But it takes a little while to come down. And it's because of lags in things like transportation services, and particularly owner's equivalent rent. And so as we track this thing out, it's going to hit 2 on CPI and on core CPI by late next year. And that's the track it's on. So I think you have to wait for that to play out. And then you realize that, okay, where does that leave us? That leaves us in a low inflation, slow growth economy. I think the Federal Reserve will be cutting interest rates obviously faster if we end up in recession. But I think you have to sort of look out beyond the volatility of inflation that we've seen in the last 2 years to realize that we're headed for a place of slow growth, which looks quite like a decade ago. I think that's really sort of a return to where we were 10 years ago.
If that's the case, why wouldn't you take a look at where markets are positioned and just load the boat with 30-year treasuries and say, everyone's wrong. They think that inflation could get unmoored if the Fed is less aggressive. I don't.
I wouldn't back up the truck, because I think there are better opportunities in markets than 30-year treasuries. I mean, I do think that the bond market overall is better priced than it's been for many, many years. And I think there is a one-time capital gain there as rates come down, as people realize the Federal Reserve is going to have to cut rates. Because sooner or later, this economy will stumble, and a 4% 10-year treasury yield will turn to a 3% treasury yield or a 2% treasury yield, and people will make a capital gain. But I think there are better long-term capital gains to be made still in the equity market. Right. But I wouldn't be underweight fixed income right now. And within fixed income, I would be definitely long duration and short credit. I don't think you're getting paid for taking credit risks. You are getting paid for taking duration risks.
Dr. Kelly, I've got to do this. It's too important. Jason Furman of Harvard just comes out with the mathematics on the annualized view. 12-month annualized, 4.7% core. 6 months, the view is 4.1%, a lesser disinflation. 3 months, which is what I look at, 3.1%. David Kelly, the 1 month annualized core CPI is 1.9%. Can you go short-termism and look at those 1 and 3 month statistics? Are they a valid tool to gauge disinflation?
I don't think so, looking at the CPI index, because what's really going on is you've got these weird categories in owner's equivalent rent, actual rents, and transportation services. And I think you just have to track what that's doing. I agree with the general proposition that core services inflation and inflation in general is fading here. I do not think it's getting pushed up by wages. I do think it's getting pulled down by competition and by increased inventories. So I agree with the result, but I think that the short-term view is really being affected by the way the government measures these things.
David, thank you so much. David Kelly with J.P. Morgan this morning. Lisa, I can't say enough about this is the debate into the weekend and the debate into Jackson Hole. You're looking at 1 year core CPI of 4.7%, or as Professor Furman says, do you go short-term and look at 90 days and say this is the inflation trend and it's a disinflation, to a core CPI right now of 3.1%. That's a huge debate.
And if you just take a look at the basic numbers, you could see that CPI just posted the smallest back-to-back gain in 2 years.
Nice,
so it's definitely
Yeah,
ending up with this disinflationary kind of feel. If you look beneath the headline, some of the most incredible increases in costs, nursing home and adult care, costs surging by the most on record. You could see housing accounting for 90% of a lot of the CPI
I think
gains.
that's important. That's true.
You have a lot of, rather than the other, but I do think, you can look at medical costs that have been increasing dramatically. You can
And
look
they
at
do in
other
the fall.
areas.
Yeah, seasonally medical always pops in the fall.
But the costs that people are feeling are still climbing. It's just that you can say at a much slower pace, or even if you take a look at some disinflation, and as Neil Duddy even conceded, there is more disinflation in the pie coming from used auto prices.
I look at David Rosenberger, Edward S. Hyman, and they're going to just say to me the disinflationary trend last 90 days is in place. That's what they're going to say.
Yeah, but year over year.
Jerome Powell can't say that. He's got to stick with year over year.
I mean, we're coming from also the highest inflation ever.
Yeah.
Or at least 30 years or something like that.
Well, here we are. Stay with us. The equity markets lift. This is Bloomberg Surveillance.